Hey guys, I hope I'm audible to you. I'm waiting for all the students to join. Meanwhile, just let me know if my voice is clearly audible and I am visible to you as well. Yep. Hello, mic check. That's great. That's great. Audible to all of you. Awesome. Okay. So we already have 135 students in. I will be waiting for more to join in. Make sure in whichever WhatsApp group that you guys are part of, which is related to SBR, make sure you share this link with everyone. Let them be in this session because this is going to be super duper helpful. It's free for all. And I believe everyone should take advantage of it because if ever there's a free resource, right before your exam, we plan it strategically and we bring it up to you so that all your doors of the brain are open towards your IFRSs. Okay, so now I'm going to start with the grand revision just in a minute. I want everyone to be super duper energetic during this session. Okay, whatever I ask you, you have to drop it in the chat box, whether I read it or not. I want you to drop whatever I say. If I say yes or no, you have to drop the yes or no in the chat box. So if I am putting an energy into the session, I want the same energy from all my viewers. Okay, so it's just few days before our exams. Let's buckle up and let's give our best shot. So I officially welcome you all to the grand revision of SBR for March 2025. Now, guys, today in this session, I'm going to cover with you all the things that are necessary for SBR of March 2025. And not just SBR, I'm also going to discuss FR. So you all know FR is something that we did in the skill level and then we came up to SBR. So FR and SBR are very much linked. So first half of my grand revision will be dedicated to the concepts which overlap between FR and SBR. And as usual, the second half of it will be related to just SBR. Okay. So let's get started. Let's get started, everyone. So the first thing, guys, what we have in our IFRS for all these students, whether FR or whether SBR, you all must know it, that IFRS spoke about the language of accounting. Yes, language of accounting. So basically, whenever we communicate, today I'm communicating with you, I'm using the language of English. Similarly, when an accountant or a reporter or any person who's doing the communication has to communicate in the form of IFRS, that is known as accounting language. And ma'am, if this is a language, do we have different languages apart from IFRS as well? Yes. So if you talk about your domestic country, quickly drop down which country you are from. I want it in the chat box. Which country all my viewers are from? Yes, we have we have all the countries accounting standards which are domestic languages. For example, I'm from India, so we have Indian accounting standards. Someone might be from UK, they have UK GAAP. Someone might be from USA, they have US GAAP. So yes, there are different accounting languages, but what we call as international language, just like we have English language, it is IFRS. So it is something which was made because we want to globalize. Okay. So IFRS is something which was made because we want to globalize, and we want all MNCs that they do not just cater to the local investor or the local potential shareholder, but also an international shareholder. So now I can look at the financial statements of someone who's doing work in UK and Dubai and maybe in USA and still understand their financial statements because maybe they've used IFRSs. So being an Indian, I might know IFRSs even if I'm just an Indian CA, not maybe the CA of another country. Still, I'm able to understand the international financial statements. Why? Because we have this leverage of IFRS. So these days, IFRSs are so much in trend, like, not just trend. I would say these are in need these days. So we need IFRSs to our rescue in the stage of globalization. Okay. So yes, let's now discuss that what are the basis of the preparation of IFRS. Now, the basis of preparation of IFRS is coming from conceptual framework. What is conceptual framework? And what you need to revise from this topic is in your syllabus that it is the theoretical principles or based on which IFRSs are made. Now, these theoretical principles are basically telling you what are the qualities of financial statements. Ma'am, what are financial statements? Financial statements, we have different types. We have statement of profit and loss. We have statement of other comprehensive income. We have statement of financial position. We have statement of cash flow, and we have notes to accounts. Right? So these financial statements are prepared on the basis of IFRSs, and these IFRSs are based on conceptual framework. Conceptual framework tells me that I have to make such financial statements which are qualitative. What are the qualities of financial statement then? Number one quality that you need to mug up, literally mug up. Number one quality is it should be relevant. What do I mean by relevance? Relevance means it should include everything material and it should exclude everything which is irrelevant or which is immaterial. Second is faithful representation. Yes, faithful representation. Now, what does this faithful representation mean? What faithful representation means that I am including everything that is not just material, but that is also which is complete, which is neutral, and which is free from error. So something which is PNF, complete, neutral, and free from error. So this is the quality, the basic two qualities of financial statements that you have listed in front of you. Now, secondary qualities of financial statements are, someone write it in the chat box, CTUV. All the TGNs know about it, right? So all the students studying at EG, you know what is CTUV. This is comparable, that the financial statements must be comparable. They must be timely. So timely means if I made a financial statement for this year, it should be available maximum in 2-3 months, not more than that. I cannot, there's no need of a financial statement of 5 years ago to be made today. So it should be timely, right? Timely. It should be understandable. So someone who is basically coming from non-commerce background should also understand the financial statement. So understandable, plus it should be verifiable. Verifiable means I should be able to vouch it to its source document. There should be a proper source document in terms of bills, in terms of invoices, to which I can go back. Yes, to which I can go back and check out that, okay, what is the source of my statements? So this is what I mean by conceptual framework. Now in your syllabus, one more important aspect. In 2018, your CF was revised. Where in CF, first of all, we deleted the concept of probability, okay? And we also introduced a new term that is economic resource. So previously we used to have a term known as economic benefit. Now we have a new term that is economic resource. So where was this term probability actually used? That should be your question. So in the definition of assets and liabilities. So in the financial statements, there are different elements, okay? There are different elements. What are these different elements? We have assets, okay? We have liabilities, we have income, we have expense, and we have equity. Now, the asset means what is the meaning of asset? Asset is it is an economic resource which will lead to inflow of economic resource. So it is something that you control. So it's an asset is something that you control, which might be tangible or intangible, which will lead to inflow of economic resources in future. Previously, we used to say that it is probable that inflow will happen. But now we have removed the word probability from its definition, right? So inflow of economic resources, and this is something that is arising because of a past event. So today, if you have a property, if you have a piece of land, why do you own it? Because yesterday you bought it, or maybe your parents bought it. So that's a past event, and that is why you still own it today, right? So it is because of a past event which you control, which will lead to inflow of economic resources. Now, when I say control, if you have any memory, because this is a revision, if you have done IFRS 16, you would know that there are certain leases which are not recognized because we do not have the right to use asset. So right to use asset exists if you control it, if you can direct its use, right? So some assets we cannot control. Another example of it, let's suppose I have trained my employees. So today I'm giving training to you for IFRS. So each person who's sitting here, 200 people are sitting here. Can I control how much they are understanding what I'm saying? I cannot control that. I am training. I'm giving equal training to everyone, but what your understanding might be different from what other is understanding, right? So that is what you cannot control. So training of employees is not something that is capitalized because you cannot control it. It's not your asset. It's your expense. Then what is liability? Liability is something that is of obligation, present obligation. Yes, which would lead to outflow of economic resources. Now, again, here we used to use the term probability, which now we have completely given up. We do not use this term of probability anymore. We used to refer to probability, okay? We used to refer to probability that it was probable that outflow will happen. But still, this term is used, if you remember, in IS 37. So in IS 37, we still, when we differentiate between a provision and contingent liability, we talk about chances of the event. If it is possible, then a contingent liability. If it is probable, then a provision. So basically, you're talking about probability, right? Then you're saying the CF has erased the concept of probability. So this is a conflict between IS 37 and conceptual framework. So if there's a conflict between two things, that is the CF and the IFRS, which one will sustain? Yes. Which one will sustain? Yep. IFRS, very good. So which one will sustain? It is the IFRS which is going to sustain. So we are not going to mention that, okay, because CF is saying there is no probability, so let us not put probability in IS 37. No, it is the IFRS which will sustain. Okay, then what do I mean by income? Everything good is an income. Increase in assets, decrease in liabilities, increase in equity is an asset. Is an liability, is an income, okay? What is an expense? Everything sad is an expense. Something that decreases my asset, for example, depreciation, it's an expense. Something that increases my liability, it's an expense. So your entry is P&L debit, liability credit. Something that decreases my equity is also an expense. But there is a conflict here. Only the SBR students would understand this conflict. If you remember something from IFRS 2, share-based payment, that is equity settled share-based payment. What is your journal entry? P&L debit, equity credit, correct? Expense debit, equity credit. For share-based payment, that is equity settled. And I just told you that expense is something which reduces your equity. But when I credit my equity, equity is getting increased. So does that meet the definition as per CF? Is that accounting treatment correct? That is to record an expense and also increase your equity. Is that accounting treatment correct? The answer is yes. Because again, when there's a conflict between CF and the accounting standard, at the end of the day, which one will sustain? The accounting standard will sustain and not the conceptual framework, right? So what would be the reason behind it? Let's discuss the reason. Okay, FR students, please put hands on your ears for a while. So your entry in share-based payment is expense debit, equity credit, correct? And I am saying that expense is anything that decreases the equity. So that is clearly a conflict in this entry of share-based payment. So now here they consider, they've given certain logics, the IFRS 2, the people who made IFRS 2, they've given certain logics. They're like, okay, what we are assuming is, we are not relating this expense with this equity. Rather, we are saying we had some bunch of people who were a human resource. Okay. So we had some bunch of people working with us who were our human resource. Okay. And now, because we are deriving their services, we are taking their services from them, we are reducing our human resource. So we are using our asset. Our asset is reducing because we are taking work out of them. So that is the reason we've treated this as an expenditure, because we are using our human resource, and in return of that use, we are giving them a payment in terms of equity. That's what they've given as a logic. So it's not like something that whether we really, actually agree with them or not, but that's what they say. That's what they say, right? So that is something that's a conflicting part. Okay, that was about the definitions. And now the last definition, what we have is of equity. So equity's definition is when you have share in the residual interest, or you can say residual interest in the net assets of an entity. So residual interest in the net assets of an entity, that means the worth of that company. Net assets are worth of any company. And if you have share in that worth, then yes, that's your equity. That means you are equity shareholder, right? So this is what we mean by the various elements of financial statements. Now let us move on to the first set of IFRSs that we are going to discuss. It is going to be a fast track, but before I move into this, are we all ready? How's the Josh? Are we excited? Come on. I want all of you to type it in the chat box. Audible, loud and clear. Yes. Awesome. Awesome. Is my mic clear to you? The mic clear? Hello, mic check. Hello, hello. Okay, just give me a minute. Let me see what's wrong with it. Give me a minute. Yes, guys. Am I audible to you? Hello, mic check. Is it any better? Perfect. Awesome. So I'll hold the mic in my hand. Yeah. Let me know anytime you have an issue. Let's continue. Really sorry for this disruption. But anyways, let's continue with our session. We were talking about the IFRSs. So the first thing that I'm going to talk about is IS 16. Then I'm going to talk about IS 38. And then I'm going to talk about investment property, that is IS 40. Okay. So what are the major differences between these three standards is what my, you know, Okay, so let's talk about this. What is the difference between these three standards? So IS 16, we talk about property, plant, and equipment. So this property, plant, and equipment is basically anything that you use in your business for manufacturing. Okay. Something that you use in your business for manufacturing. If you want, you can take handwritten notes along with me. Something that you use for manufacturing or you use for your admin purposes. So like an office building. So when I use a factory, that is being used for manufacturing, whereas an office of a company is used for administrative reasons. Then if you have any property that you hold, that you stay yourself in, so owner occupied, plus also given on rent to others. So that is also classified as property, plant, and equipment. Okay. Now, what is IS 38? IS 38 talks about any asset which is intangible. Now, by intangible, I mean it has no physical substance. Yes, it has no physical substance. What do I mean by physical substance? Anything that I can touch, see, or transfer has a physical substance. But something which cannot be touched, seen, or transferred does not have a physical substance. For example, goodwill of a company. Yes, goodwill of a company. Does it have a physical substance? Of course, no. It does not have a physical substance. It's a reputation, it's a quality. How hardworking you are. Is it something that you can touch? No. Is it something that you can feel? Yes. So something that you can feel, something that you can, just get a vibe of, that is intangible, but something that can be also be transferred. Yes, that is something. Yes, that is something that is intangible. Is it? Okay. So now no physical substance. Second thing, which is the feature of IS 38 is that it is basically identifiable. What do I mean by identifiable? Something which can be sold separately. That's number one. Or it is arising out of a legal or a contractual right. Legal or a contractual right. So something which is cannot be seen but can be sold separately in the market. For example, let's suppose a company have a customer list, their marketing data. So how they're marketing, so maybe that's just something that they hold. They cannot, just publicize it or just share it publicly, but they have it. That's their confidential data. So if someone wants to buy that data from them, they might have to pay them. So their customer list can also be considered as something that is sold separately. Can you sell your license? You guys must be driving in your respective countries. Can you sell your license to your friend or your brother or your sister? Of course, no. So what is that? Is license not a intangible asset? Of course, ma'am, it is an intangible asset, but then it cannot be sold separately. But yes, it is arising out of a legal or a contractual right. That is why the license is identifiable. Yes? Okay. Then intangible asset is something which can be measured reliably. Okay. You should be able to measure it reliably. And of course, it should, lead to probable economic inflow of resources. So it should lead to inflow of resources. So that is what I mean by intangible asset, which all the students, whether FR or SBR, specifically SBR, you guys can use this theory in your, your case studies. When you state the standard as it is and then you apply it to the case study, this is what information you can use while building your answers. Then what do I mean by investment property? Any property which is tangible property. It is held for either capital appreciation. Yes, it is held for capital appreciation or it is held for giving on rent to others. That means third party. So you bought a property solely for earning rental yields, or you bought the property solely to just keep it idle and let the property price increase and then finally make the gain through appreciation. So many people, they invest in off-plan properties. So sometimes the properties are not even ready. And still people get into the transaction, maybe, in the pre-launch, soft launch of the property. Why? Because they want appreciation on that property, on that plot of land, or maybe on that particular apartment. So that is what is known as investment property. Now, what is the accounting treatment of all these three standards? Let's discuss the accounting treatment of all the three standards. Very important. First of all, initial accounting treatment. All these three standards have same initial accounting treatment. That is, the asset is kept at cost. What is the cost? It is the initial purchase price. Okay. So initial purchase price. In that you add your directly attributable cost. Now these directly attributable costs are any costs which are incurred to bring the asset to its current use, or like for example the cost of installation, the cost of transportation. So if you buy a property today, so maybe it's initial cost that the cost of cleaning that property before you can use that property, or painting that property before you use that property. That is all capitalized in the cost of the asset, right? So purchase price plus directly attributable cost. And further, even the irrecoverable taxes. What are irrecoverable taxes? So for example, I have paid some GST or VAT. So usually whenever I pay GST as a business, I would, have a GST come back to me. So to my students who are studying in India, we charge GST, okay? We don't charge exclusively, but we pay it out of the fees. So when we pay it out of the fees, and if I as a customer, as a business, as TG professionals, if I incur any expenditure, I also pay GST to other suppliers. So whatever GST I have collected from my students versus whatever GST I have paid to any supplier. For example, when I purchased this board, I paid some GST. So I can take that paid GST back by getting a deduction from the collected GST. So whatever GST I collected minus whatever GST I paid is the net amount that I owe to the government, right? So sometimes what happens is that whatever GST you pay, you cannot recover it. Maybe because you are not GST registered or VAT registered, so you cannot get back the tax what you've paid. So maybe let's suppose I was not registered for GST and I paid GST on this board, but I couldn't get that GST amount back in my pocket. So that would have been my irrecoverable tax. And that irrecoverable tax, then I would have capitalized in the cost of my asset, right? So that is what I mean by irrecoverable taxes. Then I also add present value of dismantling cost. So present value of dismantling cost. So every asset has to be one fine day dismantled. So whenever you dismantle it in the future, you create a provision out of it today itself. And whatever you have to incur in future, for that you need to calculate the present value, of course. And at any point, whenever I calculate present value, let's not forget to unwind the interest. So UOI, what do I mean by UOI is unwinding of interest. So whenever I will calculate a present value, I would also unwind the interest. So for my students, I call it as they both have siblings. So whenever this sibling is going to order any pizza, this one is going to come dancing and be like, oh, I also want to share in that. So that's why PV, whenever I calculate present value, unwinding of interest comes along with it, right? Okay, that's great. That's great. Okay, then let's talk about the borrowing cost as well. That is also capitalized as per IS 23. So in IS 23, we talk about qualified asset. So any asset which takes substantial time for construction. So whatever is the time of its construction, and if you've taken loan for that construction amount and you pay interest on that loan, so when the loan was going on and also the construction was going on, for the time when both these lines or timelines were overlapping, that means the construction was also going on and the loan was also going on. During that time, whatever interest cost you incur, that is capitalized into the cost of the asset. That's what the IS 23 says. Now, let's discuss the subsequent accounting treatment. What is subsequent accounting treatment for these three standards? So number one, IS 16. We talk about two models, cost model and revaluation model. Now, the cost model says keep your asset at its carrying amount, that is, its purchase price minus any depreciation, or purchase price or cost, whatever you call it as, minus depreciation minus any impairment. That is cost model. Whenever the name of the model is same, the rules will also be same. So we have the same cost model in IS 38 and same cost model in IS 40 as well. So there is a cost model and then there's a revaluation model. I discuss about revaluation. Similarly, in IS 38, we have cost and revaluation model. Can you tell me which models do we have in investment property? We have cost model, yes, cost model and fair value model. Very good. So we have these two models in investment property. Now, okay, let's talk about revaluation and fair value model. Because, of course, we've discussed that the rules of cost model are same for three standards. Because whenever the name of the standard or name of the model is same, the rules are also same. Let us now discuss the difference between the revaluation model and fair value model. Yes, let us discuss the differences between the two. So the revaluation model says that you have to take your asset to its fair value, not at regular intervals. No, not at each reporting date. No, you have to take it to its fair value whenever necessary. That means whenever the difference between the carrying amount versus the fair value is significant. So that is when I'm going to take my asset to fair value. Whenever there will be revaluation upwards, yes, whenever there will be revaluation upwards, this will go via other comprehensive income. Why? I made a video on this, a very good reel on this, where I explained you the difference between how you have your food in plate and water. So you always focus on food. Just like that, investor has P&L and OCI, but his focus is always on P&L, and he thinks that OCI is a secondary statement. So now, if something like a revaluation model is there, the property, plant, and equipment was purchased with an objective of doing business. It was never purchased with the objective of capital appreciation. So I never buy an office with an objective that let the price of my office increase. No, or let the price of my office building increase. I buy it from a perspective that what is the right location so that I have a footfall of people coming into the office if it's a retail industry. Or I buy it from the perspective that what will be the most cost-effective area for me. Something which is nearby to the metro so that the employees can easily come, which are the good connectivity. So I just think about all those stuff. So for me, capital appreciation is not my objective. My objective is business. Now, if capital appreciation happens in that situation, it's just an extra gain to me. And that extra gain, since it is not very primary to you, it goes via other comprehensive income. Because that's the statement which is not primary to the investor as well. But if there is a revaluation downwards, if the value of that property decreases, now we are going to become a hypocrite. So we said that our objective is not increase in value, but if the value decreases, that's a phenomena to us. That's a disaster to us, isn't it? The property that you purchase, its values have declined. So you, of course, will be worried about it. And if you would be worried about it, that is something which will worry the investor as well. So it's primary to him and it goes via P&L. So revaluation upward goes via OCI by the name of surplus, revaluation surplus. Revaluation downwards goes via P&L. And whenever there is a revaluation downward, they first say that take out the loss via the previous revaluation surplus related to that asset. So your entry is revaluation surplus debit, asset is decreasing. Yes, so asset will be credited. But before that, what else is debited? P&L is debited. So revaluation surplus debit Statement of profit and loss, debit, asset, credit. That's the journal entry that you pass in your revaluation downwards. Now, if I talk about fair value model, that's quite different. Fair value model says that first of all, you'll take your asset to its fair value at each reporting date. So you're not going to wait for any more time. At each reporting date, you're going to take it to its fair value, and that's for sure. Yes. And then further fair value model says that whether it's a fair value increase or whether it's a fair value decrease, it must go via statement of profit and loss. Why? Because what was your objective of buying a property? That you were seeking investment. You wanted capital appreciation. You wanted the price to increase or decrease. So that was your primary objective. So of course, whatever happens to the fluctuation of fair value, that shall go via statement of profit and loss. Now the question, do I depreciate any property which was held under revaluation model? Yes. You depreciate your revalued asset based upon the revalued amount divided by the remaining life of the asset. You're still using that property even if the prices have increased or decreased, you're still using it. So you will depreciate it. But that's not the same case in fair value model. Because in that situation, you are not using that property in your business. You're just keeping it idle for appreciation or for rentals. So it's not getting used. If something is not getting used, it is not getting depreciated. So you have to decide till this date, was your brain depreciated? So if you've used your brain so far, it is depreciated. But someone who's not used if you talk about a child who has not used his brains yet, maybe he's not seen any, why was childhood so good? Because we were not depreciated yet, right? So any fair value model, that is any investment property kept under fair value model, is never depreciated, right? So that is what you should know from the basic differences of revaluation and fair value model. I want a quick confirmation in the chat box. Are we guys clear on it? Like crystal clear? I'm coming to see the chat box. Yes. Also, everything good with the mic? Mic check. That's great. Okay. Let us continue. Let's talk about intangible assets a little bit more in detail. So basically, the intangible assets, they are of two types. Okay. So intangible assets are of two types. One is definite life intangible asset. Another is indefinite time intangible asset. So definite life means that the life of the asset can be measured. Whenever the life of the asset can be measured, it is amortized. So you amortize a definite life asset over the life of that particular intangible asset. Indefinite means it is going to go on forever. Okay? Or you cannot measure its life. So we do not amortize them because we do not have their life available with us. So what we do is we conduct annual impairment review on them, which we are going to discuss in IS 36. Right? Then lastly, in intangible assets, we talk about research and development. Research and development. So as per IS 38, okay, there is a proper topic on research and development, and they say that research is expensed whereas development is capitalized. Yes, research is expensed and development is capitalized. So how to decide which expenditure is research and which one is development? We need to meet the criteria of Pirate. Okay. we need to meet the criteria of PIRET to classify any expenditure as development expenditure. What is the PIRET criteria? Whatever expenditure I am incurring, it will lead to probable inflow of economic benefits. Again, the concept of probability kicks in, which is against the conceptual framework, but still we are using it, right? In the IS 38 also, we are using it. Then we have an intention to complete the development. We have the resources to complete the development. We even have the ability to do so. Yes, there is technical feasibility to do so. Then we have a reliable estimate of that particular expense. So if all these criteria are met, then we say that particular expenditure is development, otherwise it is research. So what is research is, treated via P&L, and whatever is development is capitalized. Okay, let's move on. Let us discuss few general points that you should know. Revenue-based amortization is something which is frowned upon. It might be allowed, but it is frowned upon. Revenue-based amortization. Because what does it mean? It means, let's suppose I buy a laptop and I say I bought it for, let's assume 50,000 or 5,000 US dollars. Okay. And I say, based upon how much revenue I generate from that laptop, I will depreciate that laptop. That's not correct. The laptop will be depreciated on the basis of how much I have used. That necessarily does not mean that I am generating revenue out of it. Maybe I'm just using it in my business and I'm not generating any penny out of it. So revenue-based amortization is something that was tested in SBR, Lyra company question, if you remember. And this is something that we frown upon, right? But if you use revenue as a basis to, calculate your costs of the asset, that means if you're calculating the cost of production of your asset on the basis of revenue, then because of the matching concept, you might accept this revenue-based amortization. So matching concept is, if the source of the cost of production was revenue, then the source of depreciation of that cost can also be revenue. So that's the only exception where revenue-based amortization can still, or revenue-based depreciation can still be, you can say, accepted. Okay, I would not say highly accepted, but still somewhat accepted, right? Okay, then let's discuss more about it. We have another question that was McKee company question in SBR, where we saw that there were certain football players, okay, and these football players, whatever contract we had with them, were treated as an intangible asset. So if you have any player playing for your team and that gives you exclusivity of that player, so whenever you get that right to exclusivity, you treat it as intangible asset. I hope you remember these important two questions which had something about intangible asset. Then again, for a few of the questions in SBR, there was a question which asked that why determining the life of an asset is a task, especially in case of intangible assets. Why is it a task? Why? Because of course, life of the asset is not a fact. That's an estimate. And if I talk about intangible assets, they are all unique. My license, my patent, my trademark, my brand is different from yours. It's a unique asset. We do not have an active market of brands of TG professionals. Similarly, we do not have active market of brand of Apple, right? So if there is no such active market or there are no such identical or similar assets, so we can say that yes, it's difficult to see what is the fair value of that asset and what is the life of that asset. So that is something that you should know, that why, yes, that was Corbel company, why the life of the asset is a task to measure. Okay, so if you have understood it, I want that one like on the video, on the live stream. put that one like and throw a thumbs up in the chat box. We are all clear till here. Shall we move on to the new set of standards, that is IFRS 15, 16 and 9? Yes, let's move on to it. That's great. That's great. So let's discuss. Okay, before that, let's discuss IFRS 5. Again, a very important standard from all the perspectives. I know there are some AAA students sitting here as well. So from your perspective also, IFRS 5 is very important. This is on NCA held for sale, yeah, and discontinued operations. Discontinued operations. Now, what is NCA held for sale? When your assets meet the criteria of CAPSIN, so only the people who know me or have attended any of my sessions would know what CAPSIN is. It's a acronym to remember the concept. So IFRS 5 lays out certain conditions. That means I should have commitment to sell that asset, commitment to sell the asset, okay, active plan to sell. By active plan, I mean that I should be already marketing for it. I should already be looking out for buyers for my assets and maybe having certain negotiations with them. So active plan to sell. Then I should be selling it. That means the sale should be probable. Yes. Then sale should be in sale is in present condition. That means you will not conduct any repairs or maintenance on it. You will sell it in the present condition only. The sale will be in 1 year and there will be no change to the plan. Now, once the CAPSIN criteria is met, I will classify that non-current asset as held for sale. Now, what do you do special for any asset which is held for sale? So what is the accounting treatment? What is the accounting treatment for the assets that you hold for sale? First of all, you will stop depreciating that asset. Because what did I tell you? You are supposed to sell it in the present condition. That means you will stop using it. Once you stop using something, stop the depreciation. So stop the depreciation. Second thing is classify that from non-current asset to current asset. Because of course, you're going to sell it in 1 year. And then also take it to its lower of cost, that is the carrying amount, and net realizable value. So if I sell that asset today, what will be its NRV? So I will keep it at lower of these two. And whatever will be the loss, that will go via statement of profit and loss. Right? So this is what I have to do for IFRS 5. Then what else? What else has to be done? Stop the depreciation, classify it, take it to lower of cost and NRV. Now we will discuss about discontinued operation. What do you mean by a discontinued operation? So discontinued operation, as I said, is something that you're going to discontinue where CAPSIN criteria is met. But that particular operation is not a single asset. Rather, it is a separate major line of business. Okay, it's a separate major line of business. Or it is separate because of its nature, the type of work that we do in that business, or because of its geography. Or because of its geography, right? Either because of its nature or because of its geography. And it can also be a subsidiary which was purchased with a view of reselling. So something that you purchase with a view of reselling can also be your discontinued operation from the day one. So yes, some companies, they simply buy the subsidiaries because they want to trade with them or they want to sell them. So that is reselling. And from the day one, you can, avoid to consolidate them and just simply treat them as discontinued operation. Now, what is a discontinued operation? I've told you, but what is the accounting treatment? Yes. What is the accounting treatment of discontinued operation? So first of all, it will be treated separately in statement of profit and loss as profit after tax from discontinued operation. So that will be shown as a single line item. I will not make any extravagant details of that operation as expenses, as income. No, only profit after tax will be shown separately in my statement of profit and loss, which will relate to that discontinued operation. Correct? And then rest of the rules are same. That is, take it to lower, all the assets will be taken to lower of cost and NRV, and I will stop depreciating those assets. So I'll stop the depreciation of those assets. That's surely going to happen. So that is what I mean by a discontinued operation. Are we guys clear on that? Yes. That's great. Okay. Awesome. Now let's discuss IS 36. Impairment of asset. What is impairment? Impairment is reduction in value of the asset. Now, whenever there is an indicator, I would see whether the reduction of my asset has happened or not. Now, that indicator can be an internal indicator, yes, or it can be an external indicator. So, internal indicator can be that a machine is there which used to produce 100 units or products in 1 minute, and now it has started to produce only 10 units. So, that's an internal indicator, decline in the performance. External indicator can be some kind of disaster which has happened, something was stolen, something that is not in your control. That has actually happened to you, just like COVID. So whenever these indicators exist, I will conduct the impairment review. What happens in the impairment review? We compare the carrying amount. Yes, we compare the carrying amount with the tax base. With the tax base. And the carrying amount of the asset, okay, sorry, the carrying amount of the asset that is deferred tax is compared to recoverable amount. And recoverable amount is something which is higher of value in use and fair value less cost to sell. Okay. Now, in some questions, you will see that the accountant, being the accountant, has done this wrong. He has not taken into account this, or he has not taken into account this, or he has incorrectly calculated a value in use. So how do you ascertain the recoverable amount? It is higher of these two amounts. And impairment happens if my carrying amount is greater than the recoverable amount. So that means the amount at which I've recorded my asset is greater than its market value. So recoverable amount is something like a market value. And if it is the case, I will take my asset from this amount to this amount, which will lead to a reduction known as impairment. And how do you account for this impairment? It again goes via statement of profit and loss. So this impairment is also accounted for as a expense, just like revaluation downwards. And how do you calculate value in use? Make sure while calculating the value in use, number one thing is that you have to use a growth rate which is 0, okay? Or what is value in use? Present value of future cash flows, right? So when you calculate future cash flows, you're using a growth rate. So that growth rate either has to be 0, or it has to be reducing, or it has to be stagnant. That means you're not increasing or decreasing it, right? And second thing from value in use is whatever rate. What rate should you use for present value calculation? What discounting factor to use? Use a discounting factor which is after tax. Or, okay, we use the discounting factor which is pre-tax. Before tax, okay? Not after tax, pre-tax. Correct? That's what we use for our value in use calculations. Now, there was one question in your Super 20 of SBR. Again, FR students can close their ears. There was this one question. I don't remember the name of the question, but yes, there was this one question in the recent past papers where they actually asked about I think it was CR company, correct me if I'm wrong, where they asked about value in use, which we just recently did in our crash course, right? In our classes of Super 20. So if all the batch students, if you remember it, so there they asked you about value in use, correct? And what they said was that, okay, the value in use was incorrectly calculated because the rate used or the discounting factor used was wrong. Plus, they also asked you about that, okay, in the carrying amount of the asset, the decommissioning provision or the decommissioning cost. Okay, it was not decommissioning. I think it was lease liability. Yeah. So they said that there was a CGU, okay, which was getting impaired, a cash generating unit. And in that cash generating unit, there was an ROU, that means right of use asset. And this ROU has a related lease liability. Okay. So when we were impairing it, we were comparing its carrying amount with its recoverable amount. So in the carrying amount, they said we have not reduced the lease liability from the carrying amount of the CGU. And we said that was wrong. Why? Because if you think that this right of use asset is your asset because you're able to use that particular rented apartment, office, or whatever you are talking about, so you can only use it if you pay the rent, right? So the cost should reduce by the amount of that lease liability. And similarly, the recoverable amount should reduce by the amount of that lease liability. So just check that question out for SBR students. I think it was CR. So if anyone could confirm. What? It was Jubon company. Okay, this was not CR. This was Jubon company, which we did. Yeah. So this was Jubon company, where they talked about lease liability, yes, and that lease liability was getting reduced from the CGU. They did it wrong. They did not reduce it from carrying amount, but they reduced it from value in use. So we were supposed to comment that you should reduce it from both, okay? Because lease liability is related to the ROU, and with you can't use something which is a rented place without paying the rent. So these are related things. We should reduce it from CA, carrying amount, as well as recoverable amount. Now, with that note, let's understand what do you mean by a CGU? So CGU is a smallest unit, okay? It's a smallest unit of identifiable assets. So identifiable means they can be sold separately, but when they are used together, they generate independent cash flows from the rest of the company. So they generate independent cash flows. For example, if you have a JW Marriott, so JW Marriott has different areas. It has the areas of halls where the halls are booked. It also has the areas of restaurant and bar and pool area, rooms which are given to the tourists. So all these are separate CGUs because they're generating cash independently. So how do you conduct impairment on a CGU? You compare again its carrying amount with the recoverable amount, okay? And first you allocate the impairment to the damaged asset, which will be mentioned in the case study. Yes. And then you allocate the impairment to goodwill completely. So goodwill is allocated to every CGU because it's JW Marriott. That's why people will come to its restaurant, even though the restaurant is operating independently from the rest of the hotel. But still, the JW Marriott's reputation is going to affect how many customers will come to that restaurant. So goodwill is something which is a corporate asset allocated to every CGU, right? So goodwill, okay. And then the third allocation is to rest of the assets on pro rata basis. And make sure you do not impair current assets. You do not impair current assets. Why? Because these current assets are like inventory. It's already kept at lower of cost and NRV as per IS2. Cash can never be impaired. If I have 100 rupees with me, they will remain 100 rupees unless stolen. Receivables are impaired under IFRS 9. So current assets are never impaired, and that's how you allocate the impairment in a cash generating unit. Correct? I hope we all are clear till here. That's great. That's great. Okay. Awesome. Awesome. Now, let us start with IFRS 15. That is revenue finally. IFRS 15, revenue from contracts with customers. So guys, this standard is very important for your exam. Whether it's FR or SBR, both of papers. Okay. So you can have a lot of case studies which relate to revenue. So in revenue, we have 5 steps approach. First step is identification of the contract. So when do you identify the contract? What are the, you can say, parameters to be met before you say it's a contract? First of all, it should be a two-party agreement. Okay. So both the parties should enter into the contract. It should not be one-sided. You know, we have those people commenting on the images, nice pic, dear. And that is one-sided stuff which is happening around all over the social media. So that is not a two-side contract, right? So it should not be forced. It should be two-party agreement, or it should not be one-sided only. So that is the first parameter of condition that has to be met before you call it as a contract, right? Second thing is both the parties should know what are their rights and what are the obligations. So if I am, teaching you SPR, my obligation is to teach, right? And your right is to get the lectures. So we all know what are our rights and obligations, right? And then this contract should not be for charity. So if I'm teaching, let's suppose if I'm making free videos, okay, like this one, can I say this is a commercial substance? No, this is not a commercial substance. Why? Because there is no consideration that I'm going to receive for it. So we cannot treat this under IFRS 15. This is not a revenue contract. But yes, if you enroll at TG Profs for a full-fledged course, that is revenue for TG Profs, right? So what we are going to say here is that, of course, it should be a two-party agreement. It should not be for charity. So it should have commercial substance. Yes. Then both the parties should have, identified their rights and obligations. And payment should be received. That means the payment term should be clear. So, and it should be probable that you will receive the payment. That means if you're selling services to someone whom you know will not pay you, and still you give services to that person, then you cannot say it's your revenue from contract with customers. That's the first step under revenue recognition. Now, the second step is to see what are the separate performance obligations. What are the separate performance obligations within one contract? For that, you need to see, okay, that within one contract, am I providing distinct performance obligations? So let's suppose I'm selling a computer and along with it, I'm selling after sales services. So that computer that I'm selling plus that after sales services, these are two distinct services. Because maybe I'm selling them separately as well. So how do you determine something is distinct or not? Something is separate or not? Delivery of one should not be dependent on the delivery of the second obligation. So if I am teaching you SBR, it should not be dependent on the teaching of AAA and vice versa. Then I would say these are distinct goods and services. So the customer, from both perspectives, I have to see. The customer should also be ready to take it separately, and the supplier, that means the seller, is also selling it separately. So that's the difference, okay? So I have to see whether the customer also wants that particular service separately and the supplier is also selling those services separately. Then it is said to be distinct. Then finally, once I know what are my performance obligations, I say, let's determine the transaction price. Now, within the transaction price, we have different subheadings. Number one, in the transaction price, we talk about variable consideration. So transaction price is generally the contract price, the price that you've agreed to pay. Yes. Now, what is variable consideration? That means I'm going to pay this price, but it depends upon certain things. Now, those certain things, they will change, and there will be certain shift in the price that I might end up receiving as my revenue. So they say, what is the most probable amount that you would receive in the given scenario? Or what is the best estimate that you can have for it? What is the most probable amount that you would receive? So what is the probability of that? Okay, if I assume that, yes, let's suppose they say to the construction company that I will pay you extra if you complete the construction within 3 months. Let's suppose we are going to receive $1 million extra. Okay. Now, this is my variable consideration, which depends upon the timeline of construction. So I go with the choice that yes, it will be completed before 3 months. So what is the probability that there will be no significant reversal of my assumption? So that basically means I take the most probable situation, whether I will complete it within 3 months or not complete it within 3 months. I will analyze it. I will apply my judgment in this. And then finally, I will say, yes, whether this 1 million is my variable consideration that has to be recorded in revenue or not. I might calculate expected value here. So I might say that, okay, there are only 60% chances that I will receive this 1 million. So I have an option that I can just say 1 million into 60% is recorded. Yes, as revenue. This is known as expected value. Then another aspect is within transaction price, non-cash consideration. Non-cash consideration. Now, what do I mean by non-cash consideration? This is known as barter. Yes, this is known as barter. So let's suppose I am teaching and you are a good video editor. I always give this example. So I would ask you, first of all, if I'm talking about TG profs. So let's suppose I'm supposed to record the revenue, right? So I would first ask you, because I am receiving services from you. So I'll ask you that what is the fair value of the service that you are selling me? Now, let's say you say, ma'am, this is the first time I'm doing the editing like this as a freelancer. I don't know the price of my services. So I'll say, okay, it's okay. I understand. What are the fair value of the services that I'm providing to you? So what is the fees of SBR course? I will assume that to be my revenue. So first, you see what if available, what is the fair value of services received? That's your first consideration. If that is unavailable, then you take fair value of goods or services provided. Correct? Then the third thing that we have is your significant financing component. So while determining the transaction price, this is quite probable that, you're going to receive money later on, maybe after 12 months, 13 months, 16 months. So whenever significant portion is made in between the date of sale versus the date of receipt of payment, that is known as significant financing component. And I have to calculate the present value in this case. So let's suppose the sale was made on 1st January 2025, but the payment will be received on 1st January 2027. Okay, so sale was made on this day. So I'll record the revenue on this day, but I will record this revenue at present value. So my entry will be receivable debit, revenue credit. At what amount? At present value of that receipt. Then in the 2026 year, what I will do is I will unwind this interest. So my receivable will now increase. So what will be my journal entry? Receivable debit, because receivable is increasing. But unlike all the other unwindings of interest, this time it is not finance cost. Rather, it is finance income. So finance income credit. Correct? This is what I'm going to do. So this is significant financing component. Then what else do I have? Yes. What else do I have? Let's talk about the fourth stuff. The fourth stuff from transaction price. So we have done the variable consideration, non-cash consideration, Then we have considered the financing component. What is the fourth one? Yes, cash payable to the customer. Cash payable to customer. Now that is also possible, even though it sounds absurd that why would you pay cash to your customer? But yes. So let's suppose your customer is your supplier. You're giving services to them and they're giving services to you. So that is that you have to make a payment to them, right? So cash payable to the customer. So let's suppose there's a grocery store and then there's a restaurant. So the owner of grocery stores, he eats his lunch in that restaurant and that restaurant takes grocery items from that store. So they have mutual, you can say business going on. So I might have to pay some extra cash to them. That's okay. So if that's the case, that is dealt separately. But sometimes we have to pay cash to our customer as a form of discount. Yes, I might have to pay cash to my customer as a form of discount. Now that should be dealt as a deduction from transaction price. For example, I always give this famous example in the class. I recently conducted a crash course. Now it's not recent. It's been more than 1.5 years now. So I conducted an offline crash course in Delhi. So yes, some people were having problems in the commute for the 5-day workshop. And we gave them certain benefits of commute. Okay, we sponsored their travel to the place of workshop. So that amount versus what they paid for the workshop, we didn't do this stupid thing that, okay, first you pay us the fees, then we will give you the compensation or we will give you or redeem your travel expenses. No, we just charged at the net amount that this is what you were supposed to pay versus this is what we were supposed to pay you. So let's settle it at a net amount. So whatever is cash payable to the customer is deducted from the transaction price. Correct? Now that is about step number 3. In step number 4, I am going to allocate the transaction price to various performance obligations. Now, this allocation is going to happen on the basis of stand-alone selling price of that particular performance obligation. So whatever is the standalone selling price of that obligation, I will determine it. On the basis of it, I would decide what is the allocation of transaction price to that obligation. So for example, let's suppose the transaction price was of $1,000 and we were giving in this a computer which was worth $900 standalone selling price, and after sale services which were, let's suppose, worth another $150. So total comes out to be 1050. But we gave it at $1,000. So there was a $50 discount. How will we allocate? Discount was given in this or this. So we will prorate it. This is known as prorata basis. So we will say for computer, what is the weight? The weight is 900 divided by 1050. 900 divided by the total. I am allocating 1000. Right? So this is something which will be my share of computer. Then similarly, here it will be 150 divided by 1050 into 1000. So that's how you allocate the transaction price to separate performance obligations on the basis of stand-alone selling prices. Very simple. Again, something that was asked in one of the Super 20 questions. Okay. Let us go on. Are we guys all here, alive, listening? Yes. How's the Josh? Are we still there? I'll give you a break very soon, but are we still here? Yeah, Sial company was related to this. Awesome, awesome. That's great. Okay. So Benson, I think you have mugged up every question, huh? That's great. Let's continue. Let us talk about the famous step number 5, which is revenue recognition. Now the revenue can either be recognized at a point in time or it can be recognized over the period of time. Whatever is not OTP is ATP, correct? Whatever is not OTP is ATP. What is OTP? Not one-time password, okay? So over the period of time, whenever the customer simultaneously receives and consumes the benefit. So when the customer simultaneously receives and consumes the benefit, that is when the revenue is recognized over the period of time. Example, my dear students, all of you, as in when you are listening to me, you are receiving the benefit and you're consuming it. So after the class, let's suppose you did not pay for the batch or whatever. I can't say, oh, whatever classes you attended, no, give the knowledge back to me. No. Or let's suppose you didn't subscribe to the channel and I say, no, you attended all the videos and you didn't subscribe to the channel, so give the knowledge back to me. No. So you have already consumed the benefit, just like you consume the internet data, as in when you receive it, you consume it. So the revenue is recognized over the period of time. Yes. Then second is when you enhance or construct or create an asset which is controlled by the customer. So my famous example on this, Bob the Builder. So if I am doing a construction of a building on the plot of land of the customer, and one fine day the customer is pissed off and he says, we don't want construction services from you. Your laborers come at very late point of times. So we lay you off and we'll bring in more others or other contractors. We don't want to take the services from you. Let's suppose that's what the customer says one fine day. So can I be very worried about this and just like Bob the Builder pick up that building on my vehicle and just take it from there to my own piece of land? Of course, no. Right? So in that case, I will record the revenue on the basis of the work completed because I will have the right to payment on the basis of whatever work I have done by far. Because that customer actually, okay, that customer actually is not going to uh, you know, just simply say one fine day that you are fired because he'll have to pay me according to the work that has been completed because that was his asset that we have enhanced. Now, similarly, there can be a situation when you are enhancing or creating an asset which is controlled by you, controlled by the entity, controlled by entity, okay? But it is controlled by the entity, but that has no alternative use to you. That has no alternative use to you or to the entity. For example, a customized service or a good. For example, we just recently got over with 14th of February. So you guys must have bought some gifts here and there. Only here, okay, not there. So you guys must have purchased certain gifts and let's suppose you got it customized. Let's suppose you bought a watch with the photo of some of your friend, okay? It's not necessary that it has to be friend. Could be a normal friend also. So let's suppose you bought that watch. And now, do you think anybody else can use that watch? Even though the watch is not yet delivered to you, it's still with the company. Would anyone buy the watch which has your friend's face? No. So that means that has no alternative use to the entity. So whenever we do customizations, we get an enforceable right to payment. Plus, it's a special mention that there must be an enforceable right to payment existing in the contract. That is when I record the revenue over the period of time. Otherwise, I will record it at a point in time. Are we guys clear on this? Yeah? We all clear? Okay. Awesome, awesome. Yeah, if you're famous, then someone might buy. Okay. But then only your fan. Okay, that is not something which will have international customer base. Okay, that's debatable. Okay. Then let's discuss another aspects of revenue. What we have further is sale and repurchase. So something that was sold, it can also be repurchased. Yes, that sounds absurd, but again, this happens in the market. If you sell something, you might repurchase that in future. So what happens is, for example, Mr. A sold his house to Mr. B because he wanted to go abroad. So he wanted funds. So he sold his house to Mr. B and he said, in future, I will buy it from you. So I will buy it from you in future for sure, 100% guaranteed. I will take this house back from you and give you your money back. I'll throw that money on your face and take my house back. Now that is not a sale. This is something which we call as mortgaged loan. So Mr. A has actually not made a sale. He has actually taken a loan on mortgage on security, which is against his house. This is a situation of forward. So you are saying in future, I will repurchase it and that's 100% guaranteed. So this is a forward and it is not a sale. It is not a sale. Then sometimes Mr. B, who is actually, if we look at it, the buyer, he might have an option to put that house back in front of the seller. Put the house back and say, this house is haunted. I don't want this house. Take it back. Now, that is known as put option. So, put option exists with the buyer. That is Mr. P in this situation. So, put option can come with obligation. That means once the buyer has put forward the house back in front of the seller, will the seller have an obligation to take it back? If yes, if the obligation is there, then again it is not a sale. But if Mr. B puts the house back in front of Mr. A and Mr. A does not have any obligation in future to take it back, then this is known as put option without obligation. This is known as put option without obligation. Yes, and in this case, it is a sale. Okay, then another option that we have is call option. So let's suppose Mr. A sold the house to Mr. B. In future, Mr. A, as per the contract, has the option to call his house back. After 5 years, after 3 years, after 12 years, whatever is written in the contract, he has the option to call his house back. If that option exists, then again, it is not a sale. So if it is not a sale, how to treat it? See, if it is a sale, it is clear. We recognize the asset, record the proceeds, record the gain or loss on the disposal of the asset. But what if it is not a sale? Then what it is? Here we say if it is not a sale and the selling price is greater than the repurchase price. Okay. So what we are trying to say, the amount at which we have sold our asset is greater than the repurchase price, the amount that we will pay 10 or 5 years down the line. If it is greater, then it is a lease. Okay. And if the selling price is lower than the repurchase price, it is a loan. Why? Because basically repurchase price is paid in future. So if you will end up paying more in future, that means you're paying a premium. You're paying some interest on your loan. So this is a loan, mortgage loan. Otherwise, it's a lease. That's it. So this is what we have in IFRS 15. That is important, sale and repurchase, which is again applicable to both FR and SBR. Right? Okay. Now let's discuss. But before I move on, Can I get a quick confirmation that we guys are clear till here? Awesome. Everyone should be replying, okay? I don't want an reply from just one or two students. Everyone. Don't be that scared child who doesn't reply in the chat box. Clear to all? Yes. Yes. That's great. That's great. Awesome. Awesome. Now, let's talk about IFRS 16 and then we will take a break. Okay? IFRS 16, which is a standard on leases. So in this, what we have is, we first of all talk about the lessee accounting, which is very normal, that initially we record an ROU and we record a lease liability. So lease liability is recorded as present value of future cash payments. So whenever you calculate present value, of course, you would need a discounting factor for it. And that discounting factor is interest rate implicit in the lease. If that is unavailable, then you take incremental borrowing rate. Incremental borrowing rate. So either you take interest rate implicit in the lease or you take incremental borrowing rate for the calculation of lease liability. What is ROU? ROU is lease liability plus any payment made on or before the commencement of lease. So whatever you pay on the date of commencement of lease agreement and before the commencement of lease agreement, that is what is ROU. Now, what is the subsequent treatment of this? Subsequent treatment. Subsequently, the ROU is depreciated, yes, over the life of the lease. If it is a financial lease, then of course you need to depreciate it over the life of the asset. Then lease liability, you have to unwind the interest because of course you calculated the present value. That is the general lessee accounting that we do. Then we have lesser accounting. Yes, we have lesser accounting. Here we differentiate between operating lease and finance lease. So the operating lease is basically normal leases. So lessor is the person who actually gives the place on rent. He's not the person who takes the apartment on rent, but he's the person who gives the apartment on rent. Right? So what do we do here? In operating lease, it's a general lease, normal lease. What is finance lease? Which is something which is a very long-term lease. For example, the life of the asset is 10 years and you've given that thing on rent for 9 years. So if you see some countries, like I just recently visited Dubai and I saw that there is this area of Greek harbor where people are having leasehold properties. So you can lease it for 99 years and so. So basically you own it for yourself, but you cannot, give it to someone else like your, your kids. You can't gift it to them or they cannot inherit it from you because that is a leasehold property. So in that case, we call it as a finance lease, okay? Or it's a long-term rental. So basically you're buying that asset effectively. So what happens in this case is the lessor, what is the accounting treatment? In case of operating leases, he will record his rental income whenever accrued. And in case of financial lease, he is going to de-recognize the asset because effectively he sold the asset, de-recognize the asset and record a receivable because that is going to be equivalent to the lease liability of the lessee. So he will record a receivable, the present value of future cash payments that he's going to receive because of that lease agreement, right? That's what's happening in the finance lease. Then finally, what we have is the very important topic of sale and lease back. Sale and lease back. Again, I'm just revising the important areas. Of course, this is not something that has to be used for extensive preparation. Like, some people, they think that we can just refer to these grand revisions and, just prepare the whole syllabus and give the questions. No, these are not extensive things. We have TYUs to refer to. We have more concepts and twists and turns. This is a grand revision. So the people who are reviewing this, I hope you're giving the exam in March and you guys have done your syllabus at least once, and then you're sitting here, so you have that idea of whatever I'm saying. Sale and lease back. Now IFRS 16 says first refer to IFRS 15 to see whether that transaction is a sale or not, because of course there is a difference between the economic substance and the legal reality. So legally you might sell something, but its economic substance can be different. So you have to refer to IFRS 15 to see whether it is actually a sale or not. Okay. So once I do that, I will say it is a sale or it is not a sale. So if it is a sale, what will the lessee do? And if it is not a sale, what will the lessor do? Let us understand. See, if it is a sale, as per the lessee, what will the lessee do? If it is a sale, so lessee has actually sold the asset, so he's the seller as well. And he's going to take that apartment back on rent. So that is sale and lease back, right? So lessee is going to first of all de-recognize the asset. De-recognize the asset. Okay. Then he's going to, after de-recognition of the asset, he's going to record a, of course, he will de-recognize the asset and he's going to receive some money. So he will record the financial asset. That means either it will be a receivable or it will be banked, which will be debited. Then he will do his lessee accounting. He will record an ROU and he will record a lease liability. And he will calculate then a profit or loss on disposal of the asset. Now, in this case, how will he calculate his ROU for the calculation of profit or loss on disposal? What is the formula? All TG Prof students, you know this. How do we call it? Yes, come on, self-study students also, let's check your knowledge. How do you calculate ROU in this case? The ROU comes out to be PV, present value of the lease liability, divided by FV into CA. So present value of the lease payments divided by the fair value of that asset into the carrying amount of the asset. That is the retained amount of that asset, right? And that gives you the profit or loss on disposal. So your entry will be, when you're calculating this, your entry will be money comes in. So bank debit, ROU, you will calculate using this formula. Lease liability, credit, and asset, credit. Now you will see whether the debit matches the credit or not, and you will get a profit or a loss on disposal of the asset. That's how you treat it when the transfer is a sale in the lessee's books of account. What do you do in the lessor? Lessor is also the buyer and he's the lessor. So first of all, he will recognize the asset. He will recognize the asset. Okay, right? He's going to buy this asset. He will record a payable or he will credit bank. And then he will do his normal lesser accounting as on the basis whether it is an operating lease or a finance lease. Then if it is not a sale, what is the accounting treatment? Yes, if it is not a sale, what is the accounting treatment? In the books of the lessee, it is not a sale, but the lessee has legally sold something and received money in his bank account. So this is going to be a loan for him. Yes. And whatever rent he actually pays will be interest on loan. So he will not de-recognize any asset or he will not record any ROU or lease liability. This is simply going to be a loan. And whatever rent he pays will be treated as interest on loan. Then what will the lessor do? When it is not a sale for him, it is a financial asset. That means he's given loan to someone, and whatever rent he receives will be his finance income. Yes, that's what happens when it is not a sale. Very simple accounting treatment. Now, when it is a sale, there are two subparts. What happens if it is a sale? So, transfer can be above fair value. That means the lessee has sold the asset to the lessor at an amount which is above fair value. So, that extra amount is treated as a financial liability. That means you've received more as opposed to what was the fair value of the asset. So you treat it as a loan, like you've taken a loan, right? Okay. Sometimes the transfer is below fair value. So that amount of whatever is the below fair value, that is treated as a prepayment. For all the students who are SBR students, we have a very important TYU in Kaplan study text by the name of Mosaic on this concept. Try that out. It will clarify your concept. All my students, you guys have done it. Self-study students, try this out. Mosaic Company. Kaplan text, TYU, test yourself in the chapter of leases on this concept. That's it. So this ends my IFRS 16 as well. Are we guys crystal clear on this? Yes. Are we guys clear? Awesome. Awesome. Is this session being recorded? Yes, this is a YouTube live. As soon as it gets over, it will be uploaded on YouTube only. Okay, so let us take a break. I know. Break in the chat box. So let's take a small coffee break for next 5 to 7 minutes. And then we are going to resume with IFRS 9, your favorite standard, right? So let's meet after the break with IFRS 9, which is highly expected to come in your paper. You guys must have seen it in TGP's mock, how much we have valued IFRS 9 this time. So see you after the break. Yes, guys. I hope I'm audible to all of you. Can I get a quick confirmation? Shall we resume? Okay, okay, that's great. Let us start with IFRS 9, standard on financial instruments. Okay, so let's talk about financial instruments. What we have in IFRS 9 is, first of all, we should know the definition of what do we mean by financial instrument. So anything that gives rise to a financial asset in the books of one company and a corresponding financial liability slash equity in the books of another company. That is what I mean by a financial instrument. So something that gives rise to a financial asset in the books of one company and a financial liability or equity in the books of another company. That's what I mean by a financial instrument. Now, what is the initial recognition? Let's talk about financial assets first. So, financial assets and financial liabilities both initially are recognized at their fair value. Okay. So, they are recognized at fair value. Do we capitalize the transaction cost? So, we initially recorded at fair value plus minus transaction cost, because in case of liability, the transaction cost is deducted. We do not capitalize the transaction cost if the subsequent method followed is fair value through profit and loss. So that's the only case we do not capitalize the transaction cost. That's a very simple initial accounting treatment. Now let us discuss that what is the subsequent accounting treatment. So we have debt financial instruments or debt financial assets, and we have equity financial assets. Okay, debt and equity. Now, when I talk about debt, I have three subsequent methods. One is amortized cost, another is fair value through OCI, and the last one is fair value through profit and loss. Now, how do I decide between them? How do I decide between which method to choose? When I go for debt instruments or debt financial assets, I refer to two tests. Test number one, that is business model test. Okay. Okay. First is contractual cash flow test. Now, if the CCF test is met, what is CCF test? That I will receive the payment. That means you have given loan to someone. So I will get my repayment in terms of only cash. There is nothing in kind. So if the CCF test is met, then only I go to the step number two. Otherwise, okay, otherwise I am going to say that I will choose for fair value through profit and loss method. If the CCF test is not met, I am going to go and record that particular debt asset under fair value through P&L. If the CCF test is not met, it is recorded under fair value through P&L. But if the CCF test is met, we go to step number two or test number two, that is business model test. Now, this business model test talks about your intention. So what basically is your intent? Do you want to keep that asset for long term? Do you want to take all the contractual cash flows up till the maturity date? If yes, go for amortized cost. Is your intention, I don't know. Just like, some people in friendships also, they have such mindset. Some people say long term, okay, till forever. Some people say if it works, it's well. If it does not work, we are fine with that. That situation is known as I don't know situation. I might keep it, I might sell it. So in that case, I go for fair value through OCI. But then there is another situation where we are very sure that we are doing it on temporary basis and we are going to trade with it. We are going to sell it off in short term. So that particular debt instrument is kept under fair value through P&L. That's how you choose between the subsequent accounting treatments. Okay. Then for equity instruments, you have two methods. One is fair value through P&L. Another is fair value through OCI. Now, this is by default method. Anyone who would buy shares of a company, most probably he would be buying or she would be buying it for trading purposes only, right? They would never buy it for keeping it for long term. Some people do keep it for long term. So usually it is for trading, short term. So fair value through P&L. But sometimes some assets can be kept under fair value through OCI only if two conditions are met. What are these two conditions? Condition number one, must not be held for trading. That means you don't want to sell it. You're not an intraday trader. You're going to keep it for longer term. That is must not be held for trading. Second is you must have made an irrevocable choice. Okay, an irrevocable choice upon designation. Now, what does that mean? So I was just flying to Dubai and we have this flight with Tara, which is currently being taken over by Air India. And they have this TV, which works sometimes okay. And we were watching Three Idiots on that. If you guys have watched this movie, this is something which is a Bollywood movie, okay? But what for all the people who do not know about it, this is a very interesting movie where basically it's based upon the theme that certain parents, as soon as the child is born, they just tag them that, you will become an engineer or you'll become a doctor or you'll become an ACCA, right? As soon as they are born. So that is something which we say they've made that choice upon designation. So the day the child was born, they chose that this is what our child is going to do, even though it's something bad. That's what the movie is all about. But in accounting, sometimes as soon as that asset is coming to my books of accounts, I choose for it. You know what, my dear equity instrument, you will go to fair value through OCI, and I've chosen this for you. Now, who's making the choice? Is God making the choice? No, the accountant is making the choice. And is accountant God? No. He's a human being who's full of mistakes. Sometimes he's fall off ethics. Sometimes he's not able to comply with the even the accounting treatments. So he himself is imperfect. And then he's deciding for someone. So you will see in ethical questions, the accountant purposefully, with a malintention, make this choice. Even though the instrument is held for trading, and still he says that we made an irrevocable choice upon designation. So that he has done purposely because he wanted to keep that asset under fair value through OCI. Right? So these are the conditions, and this is the subsequent accounting treatment for both debt and equity. Now for amortized cost, guys, you all know how do you make your amortized cost table? Opening asset plus interest minus cash received gives you closing asset. This interest is based upon effective rate of interest. This is based upon coupon rate of interest. Okay. Now let's move on and discuss something more about financial assets. Now, all the FR students who are sitting here, say hi to me, all the FR students. Hello. Okay. All the FR students. All the FR students will not listen to what I'm going to say next. So you can drop out of the session and maybe join after like few minutes, maybe 30 minutes or so. So keep a check on it when I'll start with group account. So you can drop out of the session, or maybe once this live class is over, then you can watch that only one part of group accounts and you'll be done with your grand revision. But now we are starting with SBR. Okay. So let us discuss SBR from now. Yes. Okay. Let's go on. Let us discuss loss allowances. It gives you a senior feeling, no, that these FR students, they do not have this topic, but you guys have this topic. Okay. So loss allowances is basically, we are talking about impairment of our financial assets. Okay. Impairment of financial assets. Now, certain financial assets which are held or which are debt instruments, which are kept under two methods, that is amortized cost and fair value through OCI, are the only two kind of instruments which are impaired. How do you impair them? So we need to know certain terminology. First of all, credit risk. What is credit risk? When you're given loan to someone and the risk is that the person will not repay. So the risk of non-repayment, risk of non-repayment. Risk of non-repayment is what I call as credit risk. So credit risk exists, right? And because of that, some of my debt instruments are impaired. Then I calculate credit loss. What is credit loss? Credit loss is the difference. It is the difference between two things. Difference between what do you expect to receive now versus what was written in the contract. So if you have given loan to someone, let's suppose you go to a college and you've given some money on loan to your friend. And whenever your friend passes by, you're always curious, is this guy going to pay me? Is this guy going to repay my amount to me? He's just chilling in the canteen. Is he going to repay to me? So your expectations always change. So credit loss is a byproduct of your skepticism. You're always skeptical about that, whether the counterparty is going to pay me or not. So you always change your expectations that this person, my friend failed in the semester exams. Now he might have to repay or give a resit fee. So he might not give me my money back. Now that is something which I say is my expectation. That's not a reality. He's not said something to me, whether he's going to repay or not. I'm just expecting it. Right? So in this case, what I say is there's a difference between expectation versus the contractual amount, and that is known as credit loss. When I take this credit loss to its present value and when I probability weigh it, when I take it to its present value and I probability weigh it, I create a loss allowance out of it. Loss allowance is a new term, but your traditional term that was basically in basic accounts when there were no IFRSs is provision for doubtful debt. I am having a doubt whether the counterparty is going to repay or not, and that is why I'm creating a loss allowance on it. So I will calculate its present value and I will probability weigh it. Now there are two types of loss allowances. One is 12-month expected loss allowance, another is lifetime expected loss allowance. When the credit risk has not increased significantly since the inception, that means since the day you've recorded that asset, from that day till the reporting date, if the credit risk has not increased significantly, that's when I record 12-month expected loss allowance. That means what all bad things can happen to the counterparty in the coming 12 months, which will lead to decrease in my expectations from him, right? Then lifetime is when the credit risk has increased significantly since inception. Now that will be mentioned in the case study. They will give you an indicator that whether the credit risk has increased or not increased. That's based on your judgment again. And then you will decide whether lifetime expected loss allowance is needed or 12-month expected is needed. For receivables, we always create lifetime expected loss allowance because receivables anyway have, life which is lower than 12 months. So their life will be 3 months, 6 months, 5 months. So we will create loss allowance for their whole life, right? Then what else do we have? We are supposed to create the loss allowance via statement of profit and loss. So our journal entry of loss allowance is P&L debit, loss allowance, credit. That's how I create a loss allowance. Then what else do I have? There are certain debt instruments which are kept under fair value through OCI. Okay. So there are certain debt instruments which are kept under fair value through OCI. If you are going to create a loss allowance on them, so let's suppose the debt instruments fair value initially was 1,000. At the reporting date, it is $950. So there is a loss of 50. This 50 will go via the comprehensive income because this is fair value through OCI. But in the question, let's suppose they have mentioned also create a loss allowance of $30. Now IFRS 9 says I cannot reduce the asset from an amount lower than its fair value. So I cannot take it to 920, right? This is not allowed. I can record it maximum up to 950 only. I cannot take it lower than 950. So in that situation, what I'm supposed to do? I will assume that this $30 loss allowance is within this 50. I will assume the $30 loss allowance is within the 50. So I will divide this loss 50, 30 and 20. This 30 will go from P&L as loss allowance and this 20 will go via the comprehensive income as fair value movement. So that's the concept of loss allowance that we all should know. But there's a difference between credit impairment and loss allowance. So credit impairment is when the counterparty has confirmed that I will not repay to you. Now that is when I will actually credit my asset. So what is credit impairment? What is credit impairment? When the counterparty has confirmed that they're not going to repay or they're not able to repay, right? So in this case, I don't create a loss allowance. I simply pass a journal entry. This is a bad debt, so P&L debit, and my debt instrument or debt asset credit, right? So P&L debit, asset credit. That's what I do for credit impairment. Correct? Yeah. Now, okay. What else? Yes. In this case, whenever you purchase, there is a situation when you might actually purchase a credit impaired asset. When you purchase a credit impaired asset. In that case, what do you use instead of effective rate of interest? When you are making your amortized cost table of opening asset plus interest minus cash received gives you closing asset. When you're doing this calculation, instead of effective rate of interest, you will use credit impairment adjusted rate, which is always given to you in the question. That is CIAR, right? That's it. So this is from the topic of loss allowance and credit impairment. Okay, let's move on. Let's go to convertible debentures. Now these are, let's understand the meaning. If I am issuing a convertible loan note, what I'm telling that I am taking loan from you, but instead of getting payments of principal and interest, you also have an option to get shares in my company, right? That is what a convertible debenture actually is. That instead of just taking principal and interest, you can get the shares in the company. So this is partially equity and partially it is financial liability. So initially what I do with convertible debentures is I will do split accounting. How will I do this split? I will calculate the financial liability component first. So whatever is the present value of future cash flows, that is going to be regarded as a financial liability. Now, for present value, what is the discounting factor that you're going to use? The discounting factor is going to be the interest rate on similar bonds without conversion options. So if there was no conversion option, what would have been your interest rate? So you will take that interest to calculate the financial liability component. And what will be your equity? It will be proceeds minus the financial liability. So equity will be there in your equity section of the balance sheet as it is. And your financial liability, we will treat it as per IFRS 9. So on that note, let us discuss how do we treat financial liabilities. So financial liabilities subsequently can be kept under amortized cost or under fair value through profit and loss. So I keep them under amortized cost by default. Okay, if nothing is given, I will keep that liability under amortized cost. But I can also use fair value through P&L only if that liability is held for trading. Yes, some people hold their liabilities also for trading. Or another example is fair value through P&L when you want to avoid an accounting mismatch. When you want to avoid accounting mismatch. So, for example, you purchased an investment property and that is kept under fair value through P&L. And to buy that property, you took a loan. So, you're saying this property and these loans are related to each other. So, the property is being kept under fair value through P&L, but the loan is kept under amortized cost. That is quite a mismatch. So, let's keep the property and the loan both under fair value through P&L. So, whenever you want to avoid an accounting mismatch, you can go for fair value through P&L. But when you go for it, you have to decide what is the reason of changes in fair value of my liability. If the change is because of my own credit risk, now that is not market related, no? So that should go by other comprehensive income. And whatever is the change in fair value because of other factors which are market generated, right? That should go by a statement of profit and loss in this case. So credit risk, that means you will not end up paying your loan. Right? So this is the accounting treatment for financial liability. Then we have another concept of debentures. We've discussed the debentures. Okay, we've discussed convertible debentures. We have another concept of derivatives. Yes. Can you tell me what do you mean by derivatives? Come on, quick in the chat box. What do you mean by derivatives? Give me the three features of derivative. Very good. Derivative is something which has zero or less initial value. Okay. Secondly, derivative is something which will be settled at a future date. Settled at a future date. Thirdly, derivative is something which is dependent on an underlying item whose value changes based upon underlying item. Also, derivative is something that people buy for speculation. Yes. So something that you buy for gambling, for trading. It's not something that you buy for your company or, for using it in your business. Now, derivatives are usually financial instruments. So you buy a financial instrument like a future, a swap, a forward for a financial instrument. So usually a future for buying maybe shares after a certain point of time. So share is a financial instrument, or a future of making a payment at a certain exchange rate. So making a payment is payable. So that is also financial instrument. So usually you buy the derivatives for financial instruments. But there can be certain situations when you are having a derivative for a non-financial instrument. In that situation, it must be. So when you are buying a derivative for non-financial instrument. Let's suppose you say in future, I will buy wheat. Wheat, not something else. It's wheat, okay? So let's suppose you have a future contract to buy wheat at a fixed price. So now wheat is not a financial instrument. It's an inventory or it's an asset, right? It's a raw material basically. So it's a non-financial instrument. So it can be a derivative when, first of all, you must be doing it for speculation. Second thing is the contract must be settled net in cash. Settled net in cash. Now, how would you know whether the contract is settled net in cash or not? Either it is written in the contract, that future contract, that you will, buy this wheat net in cash, and if you do not buy it, you will get back the money also in cash. Or it is a past practice that usually you settle such contracts net in cash, okay? Or you will buy the wheat and then you will sell it in the secondary market and get cash. Yes. So either it's written in the contract, it's a past practice, or you'll buy the asset and sell it. So if that contract is settled net in cash, then only we can call it as a derivative. Plus, of course, it should be held for speculation. But something, for example, you bought a forward or a future contract where you say, I'll buy wheat at a fixed price or petroleum at a fixed price in future. And you want to use it in your own business. So you're going to have your own use of that non-financial instrument. You're going to use it in your own business. Now that means you're not doing it for speculation. You're going to take delivery of that particular product. You're not doing it for trading. You're not doing it for making money. You're doing it for your business. So in that case, this is not a derivative. Instead, it is an executory contract. It is an executory contract. And executory contracts are not recorded today, but they are recorded in future, okay? Whenever they are actually realized, whenever you actually execute them. So, right, this is what we mean by derivative. Now, what is the accounting treatment of a derivative? It is held under fair value through profit and loss. So initially it might be zero, but at the reporting date, maybe it is a favorable derivative. So your entry will be financial asset debit and statement of profit and loss credit because I've made a gain on that derivative. Good. We've understood this? Yes. Have we understood the derivative part and the executory contract? Okay. Awesome. So this is how we treat derivatives. Now let's come to your favorite topic of hedging. Yeah. So what we have in hedging? So there are two types of hedges. Cash flow hedge. When I was teaching this, even I used to get confused. But then I made an example to always remember it. Now I remember it clearly. What is the accounting rule? So fair value hedge, you might feel that, ma'am, how can you forget it? But the IASB says themselves there is no logic behind these rules of hedging that they've created. And it's a very complex topic, even for the accountants who are working for 10 years, 15 years. And it is treated as an inherent risk in audit because it's so difficult, or its accounting treatment is so logicless, I would say. But we have tried to create our own logics here. So what is a cash flow hedge, or what is hedging in general? So when you are having any instrument with which you are scared, for example, let's suppose I have a property abroad, okay? And that property that I have, let's assume that it's in currency of dirhams. Let's assume that because that was my recent trip. So let's assume that. And now I am living in India, right? So my fear would be that what if dirhams become weaker? Yeah. More the dirhams will become strong, I'll be happy. Not as an Indian, but as the property owner. Because if the value of a property will increase, that's good. But if the value of dirhams will increase, I will be way happier. Because then its Indian equivalent will be a greater amount. But if it happens vice versa, if the value of, I think the most recent valuation that I've seen is that 1 dirham is equal to 23.5 Indian rupees. Yes. So if this value increases, I'll be happy. But if this value decreases, I'll be sad. So my fear is, what if this value decreases? What if this value decreases? So what I can do is to hedge against my fear. This is my fearful face. To hedge against my fear, I can buy a hedging instrument. Okay, so my hedged item is my property. Yes. And I am afraid about its fair value and the exchange rate. So to hedge against it, I can buy a derivative instrument or a hedging instrument, which will give me a gain if my fear comes out to be true. If actually the value decreases, I will be afraid because of property, but I will buy such an instrument. How to buy such an instrument is not the scope of SBR, but I will buy such an instrument which will give me a gain if my fear comes out to be true. So basically, these two things should be indirectly related to each other, or they should be inversely proportional. So when the exchange rate will decrease, I will make a loss on property. But if the exchange rate will decrease, I will make a gain on derivative. So this way, I will at the end of the day have no profit, no loss, and I will be in the safe position. Now, this is the whole process of hedging. Now, the question is how to account for it. So they say if you are doing this hedging for fair value increase or decrease, if you are afraid or your scare is or your fear is regarding fair value of a certain property or certain asset, then it is a fair value hedge. So what you have to do is you have to identify what is your hedged item. You have to identify what is your hedging instrument. The hedged item will be taken to its fair value at the reporting date. And even the hedging instrument will be taken to its fair value at the reporting date. Right? And the gain or loss will go via statement of profit and loss. Both gain or loss will go via P&L. Only one exception is there. What is that exception? You can note it down. The only one exception is if the item was equity instrument kept under fair value through OCI. So if your hedged item was an equity instrument that was kept under fair value through OCI, then only you will not take the gain or loss via P&L. Rather, you will take it via other comprehensive income. That is the rule of fair value hedge. Whereas for cash flow hedge, what is the rule? Here I talk about the sibling example. Yes, sibling example, all my students know. I've also talked about this example in one of my podcasts on Spotify. You can listen to the IFRS podcast. You can search IFRS with TG and you will find this podcast where I've talked about pre-populated. It's something I uploaded an year ago, which is still relevant. Might help you sometime. So I gave this example of sibling where basically what happens is that you were, by you, I mean the younger sibling, okay, with no offense. I am the younger child at my house. And usually my mom says that my brother was getting bored because he was playing alone badminton. There was no one to play badminton along with him. And he used to say, I need some other sibling also. So I was, brought into this world for that cause. So keeping that in mind, I developed this relation with hedging that usually it is because of the item, the hedged item, that we bring the instrument into the world. So I was afraid about my property prices. That's why I bought the derivative. So it's because of the item we buy the instrument. So item is the elder sibling, yes, and instrument is the younger sibling. So usually, if your younger sibling will trouble you more, if the younger child will trouble parents more, you would see them saying, oh, we brought you into this world to help your younger or your elder brother or sister, and you are troubling us more. So you are an ineffective portion. You're an ineffective child. Okay, that's quite harsh to say, but just for relatability, okay? So you are notorious or you are troubling us more, as opposed to, usually when in childhood we used to fight, and if I used to, trouble my parents more, they used to say this to me, oh, he is such a good child and you trouble us more. So what is that? They're trying to say that the elder one was the reason they brought in the younger one, and now the younger one is troubling them more, right? So they call it as ineffective portion. Similarly, when the fair value movement in instrument is greater than the fair value movement in the item, that extra movement goes via, statement of profit and loss as ineffective portion. Okay. And the effective portion goes via other comprehensive income. So both the item and the instrument are taken to their fair value at the reporting date. If the item's fair value is increased by 10 million, but the instrument's fair value has declined by 20 million. So this is 10, this is 20. So that extra 10 is ineffective. It was also supposed to move by 10 only. Then it would have been no profit, no loss situation. But instrument troubled us more. It made a loss of 20, item made a gain of 10. So now I have a net loss of 10. So that 10 goes via P&L, its ineffective portion, and the remaining 10 fair value movement goes via OCI because it is the effective portion. So this is what fair value hedge and cash flow hedge have. Yeah? Okay. Hope we have understood it. Okay. You guys are enjoying your time in the chat box, I can see. That's great. If it was a Zoom session, I would have said, no, don't disturb me. But okay, enjoy your time in the chat box. That's great. So this is what we have in the cash flow hedge. Then finally, last topic from IFRS 9, the hedge effectiveness criteria. So you might get this question directly. What is the hedge effectiveness criteria? So the hedged item, okay, number one, the hedged item and instrument, okay, these two things should have inverse economic relationship, so that if one would increase, the other would decrease, and vice versa. Then only I will be able to settle my loss with my gain and come to a net no loss or no gain situation. Second thing is the hedging ratio or the hedge ratio should be appropriate. So basically, if you are going to have a loss on property of 10, you're scared about 10 million's loss. So you cannot buy something which is worth $100. You'll have to buy something which is worth of equivalent amount, right? So that is hedge ratio should be appropriate. Lastly, the credit risk of the hedged item. So what is the credit risk of hedged item? Let's suppose you are hedging against your payable, that money that you have to pay to ACC at the end of the year. So the credit risk that you might not end up paying it should not dominate the fair value changes of the item, right? So this is what we have as 3 rules of hedge effectiveness criteria. Only if these 3 rules are met and we have documented the hedge as hedged item and hedging instrument, then only the hedging rules will apply. And once the hedging rules apply, no other rules are applicable or no other standards are applicable to that item and instrument. And that is the end of IFRS 9. Are we all clear on this? Yes. Are we all clear on this? I want a confirmation. Adrika, you can just go back. This is something which can be moved back as well. You can rewatch that. I know it's complicated, but I hope maybe watching it 2 times can help you. Yes, there's a concept of modification of debt as well. So that is something which you guys can just do from your text. Let's not get into that complicated concept. Okay. Now let us start. Let us start with, we'll do all the small standards. Okay. Yeah. Let us talk about the another standard now related to SBR solely. So we have IS 19 and IFRS 2. Let's first talk about IFRS 2, right? So IFRS 2 is based upon share-based payment. So share-based payment, which usually happens to the employees or for the exchange of goods and services, when you pay in terms of your own shares. So there are two types of share-based payments. One is equity settled share-based payment. Another is cash settled share-based payment. Equity settled and cash settled. In equity settled, your journal entry is expense debit. Okay. And the equity is credited. And for cash settled, the journal entry is expense debit and liability credit. So you are saying I will make the payment in terms of cash for the, services that I've taken from my employees. So that is cash settled share-based payment. So in question, if you see that a share or a share option is given, that is equity settled share-based payment. Share or share options are given. When SAR, share appreciation rights are given, that is cash settled share-based payment. Correct? Okay. Now, how do you calculate this? For equity settled share-based payment, how do you calculate your expense and equity? So you must know that there is a grant date, the date at which the share options are granted. Then there is a vesting period. Okay. So vesting period means if I've given some share options to my directors, I have always attached certain conditions to those share options. That if the directors will meet that condition, only then they will get the share options. So there's a vesting period in which they meet those conditions. And finally, their share options vest. And then finally, they exercise their share option. Now, these vesting period will have vesting conditions. These vesting conditions can be market-based. It can be a market condition or it can be non-market condition. Now, non-market condition can be performance related or it can be related to how much time you're spending in the company. So market conditions are already taken into account in the fair value of the share option. So if you remember IFRS 13, which I'll discuss in a while, if you remember IFRS 13, IFRS 2 and IFRS 16 are out of the scope of IFRS 13. So this fair value of share option is not coming from IFRS 13, rather it is coming from a valuer who uses Black-Scholes model, which is a concept of your AFM paper. Yes, so Black-Scholes model is used for the valuation of the share option. Now, while doing this valuation, okay, there is the market condition is already discounted. The market condition is already discounted. Now, if I talk about non-market condition, these are what impacting that how many directors or how many employees are going to get the share options. So let's suppose the vesting period was 3 years and the vesting condition was that we gave it to 10 directors if they spent 3 years in the company. So in the first year, 10 people actually left and 20 are expected to leave in the next 2 years. So I am going to take actual people who left at the year end. I'm going to deduct that from the 10 directors and who are estimated to leave for the next 2 years. I will also account for them. In the second year, again, I will take the actual number of directors who have left and who are estimated to leave in the third year. In the third year, I will just take how many are estimated. Sorry, how many are actual. So how many have actually left the company? Yes, so that is what I'm going to do. I'm going to decide how many directors are going to really get the share options based on that. Now, how will I calculate my expense or my equity? That's the question. So let's see the formula. In equity settled, it is number of employees who are going to get the share option. Yes. Into the number of share options each employee is going to get into the fair value of the share option at the grant date. Okay. So fair value of the share option at the grant date, which is going to come from Black-Scholes model. And this is, let's suppose, the first year out of the 3 years. In the second year, same formula. This is the second year out of the 3 years. Last year, it will be 3 by 3. Yes, this is your formula for the calculation of equity and expense. Then, finally, what is the difference between equity and cash settled? Now, the only difference in equity versus cash settled share-based payment is in its calculation. So in equity, my formula was this. Yes. Just in the same formula, instead of fair value at grant date, take it as fair value at each reporting date. So that is the only difference between equity settled and cash settled. Correct? Got it? Then finally in cash settled, we also have liability, right? In cash settled, we have a liability. So let's suppose the grant date was 1st January 2025 and the vesting date is 1st January 2027. That means 2 years are the vesting period. And then finally, the directors have the option to exercise their SARs for the next 2 years in 2028 and 2029. Okay, so they have 2 years for vesting their SAR. So when they will actually exercise their SAR, that means on 1st January 2027, let's suppose I will have an opening liability. Okay, so opening liability was calculated with the formula that I gave you before. Then whenever the cash will be paid to the, whenever the cash will be paid, it will be paid at intrinsic value. You'll always pay the cash at intrinsic value. This intrinsic value is usually given to you in the question. Okay, so you will calculate what is the cash outflow on the basis of intrinsic value. Type it down in the chat box. What is intrinsic value? Yes, so this is Cash is always paid at intrinsic value. Then you're going to have your closing liability. Yes, the closing liability will be again calculated on the basis of a formula. That means how many number of employees are there, how many number of share appreciation rights each one of them have. Then what is the fair value of the SAR at that particular reporting date? There will be no 1/3, 2/3 because the vesting period has ended, right? This will give me my closing liability, which will of course not match. So opening minus the cash will not match the closing. This will give rise to a balancing figure, which will go via statement of profit and loss because it's a realized gain or realized loss because I've made the payment of liability. So I have encashed this liability, right? That's why it's a realized gain or loss, correct? That's it. So this is about IFRS 2 share-based payment. Okay. Are we all clear? Yeah. Awesome. Okay. Let's move on. Let's move on. Let's discuss IS 19. That is employee benefits. So here I'm just going to revise with you the defined benefit pension scheme. So here what I have is I have a pension obligation, which is always recorded at present value. Then I have a planned asset, which is recorded at fair value. So if your obligation is greater than the asset, that is deficit. If your asset is greater than the obligation, then it is surplus. Correct? So in your calculation of IS 19, you are going to have a deficit, let's suppose. So opening deficit. In that, tell me in the chat box. If you are watching the recording later on, you have to type it in the comment box. What happens to net interest? Net interest is added into this, right? Net interest, which goes via statement of profit and loss. Then what happens to service cost? Is it added to deficit or deducted? I'm giving a pause. Is service cost added or deducted? It is added in deficit. Whether it is past service cost or whether it is current service cost, it is added, which also goes via statement of profit and loss. Then what else is there? You have contributions into the planned asset. So if your planned asset is increasing, it will deduct or it will decrease your deficit. So if you make any contributions into the planned asset, that is going to reduce your deficit. Then benefits paid out, are they added or deducted? If you pay out the benefits, are they added or are they deducted? Very good. Benefits paid out have no impact. So neither they are added nor they are deducted. They have no impact, right? Then finally, we have closing deficit, which is given to us by the actuary. So what figure is given to us by the actuary versus what we are getting by doing this calculation? We compare these two and we get something known as remeasurement component, which is a balancing figure. And this goes via other comprehensive income, right? And it is never reclassified to statement of profit and loss. Again, in my very recent Instagram reel and ACCA shorts that I've been posting on YouTube, I've explained this concept of reclassification with a matcha tea, which is a Japan's famous tea. So you can check that out. I have explained that, what exactly you mean by reclassification. So that is never reclassified to statement of profit and loss. Then in the IS 19, we have another concept of PASC, that is Planned Amendment, Settlement and Curtailment. So usually whenever PASC happens, IS 19 says revise your or update your assumptions on the date of PASC to take or recalculate your net interest and to calculate your current service cost. Okay. So all these costs associated with or gains or loss on settlement are going via statement of profit and loss as part of service cost. So that is what I have in PASC. Then lastly, I have a concept of asset ceiling as well. Just like, we say evil eye. So even in the accounts, they say you might get an evil eye if you have a surplus, if your planned asset is greater than your pension obligation. So they always say keep a cap on it, keep a threshold. So let's suppose you were saying that my surplus is $100 million. So they say, no, we'll cap it. How will you calculate at what amount are you going to cap it? Let's suppose it is 80 million. So how are you going to keep this 80 million or calculate this 80 million? So you'll say, because of asset or because of surplus, what is my benefit? If my planned asset is greater than the pension obligation, what is my benefit? Either I will get refunds from the planned asset. So either I will get refunds from the planned asset, whatever I've contributed into the planned assets, I'll get it back as my own income, or I will reduce future contributions to the planned assets, right? So whatever is like the greater, whatever will be a greater benefit, that should be the threshold. What is effectively your future benefit from the surplus? So you will cap your asset to that amount. That is usually given in the question. So once we seal the asset, let's suppose the surplus was recorded at 100, I need to bring it down to 80. There will be a loss of 20 being recorded, and that loss will also go via remeasurement component in other comprehensive income. This is the concept of asset ceiling. That's it. So we have revised very two important concepts, IFRS 2 and IS 19. Yes, I hope we all are clear till here. Now, guys, we'll take another break of just 5 minutes. Okay. And we will start with group accounts. That is the last topic before we end this session. I'll also cover IFRS 13 briefly with you. And I have some pre-populated notes for you. So we will do it right after 5 minutes. So even the FR students, you guys can listen to the basic group accounts and then maybe leave the session. So we will discuss the 5 working notes, and then I will, quickly jump onto the pre-populated journal entries. I know you guys are waiting for it. So let's take a break of 5 minutes. Yes, guys, I hope I'm audible to you. Can you just give me a quick confirmation? Am I audible? Okay, that's great. Let us continue. Again, we are revising important concepts. That does not mean you leave any topic. You are supposed to revise all the other small standards. I will try to revise IFRS 13 and IS 37 and IS 10 with you. But the rest of the standards like interim reporting, that is like 6 months report, which should be comparable. And then a standard on SMEs is there. Some small and medium-sized entities are exempted from certain rules. So you can just read it out from your notes and you'll get to know, okay, what is there in SME. Then we have a standard on IS 33 EPFs, which is again in SBR, it is quite towards the discussion more than the calculation. So you can just revise that part yourself because it's less likely to get good amount of, marks from that area, even though 6 to 7 marks can be there. So you can revise it. But these are the areas which are very complex and are the mainstream topics of SBR, which I'm revising. So let's start with our group accounts first of all. Yes. So groups. We have basic group accounts, which is always relevant to FR and SBR as well. So let us first discuss why do we need to create consolidated accounts? So because there is control. What is control? Control exists when we have power over the investee. So the three ways we can get control is, or three conditions when control exists is that you have power over the investee or you have the right over its variable returns, okay? And you also have the ability to affect those returns. If these three features will exist, then only there will be the control in the case study. If control exists, then there is a parent company which controls the subsidiary company. Now, legally, these two companies are separate, but economically, they are one. They are one group. And that's why we are supposed to prepare their consolidated financial statements, okay? Because economically, they are together. Now, while preparing these consolidated financial statements, there are certain rules. Rule number one, add up everything as if you own everything at 100%. Second, you need to, you're supposed to eliminate intra-group transaction. Because of course, whatever transaction happens between the parent and subsidiary, that is not something which is realized. So you have to actually eliminate the intra-group transaction. Okay. So that's the second thing. Then lastly, you have to show up to the extent you don't own the subsidiary. That is NCI. So these are the three basic rules from F3. So if you ask an F3 student, he would have crammed these three rules. So these are such basics of consolidation. Then finally, we prepare consolidated statement of financial position. Let us see how a consolidated statement of financial position is prepared. We have 5 working notes. Working note number 1. Identify who is the acquirer. So basically, in our working note number 1, we are going to tell them what is the relationship between parent and subsidiary, who's the associate. So basically, in working note number 1, we are trying to see who is the acquirer. So you have certain rules in SBR that who is the acquirer. So the bigger entity is usually the acquirer, right? So the bigger entity usually is the acquirer. Then the entity which is issuing shares is the acquirer, or which is paying cash is the acquirer, or the entity which can appoint majority of the board of directors is the acquirer. Yes. then an entity which is having like, you know, uh, when the combined entity is prepared, the management of that particular entity will have the majority, etc. So these are the points through which we will determine who is the acquirer. Then finally, we will have our working note number 2, which is fair value of net assets of the subsidiary. Yes, fair value of net assets of the subsidiary. IFRS 3 says that I have to take my subsidiary's net assets to its fair value, which comes from IFRS 13 generally. Now I have to see what were the net assets at date of acquisition, what were the net assets at the reporting date, and the difference between the date of acquisition and reporting date will give me my post-acquisition movement of the subsidiary's net assets, in which the GRE, that means the parent, and NCI, that means minority interest, will have their own share. So post-acquisition movement in net assets of subsidiary, two people will have interest in that. One is the parent, another is non-controlling interest, right? So what is there in net assets? Share capital, share premium, retained earnings. You have your other components of equity. There can be fair value adjustments, which are adjusted in both the columns. There can be an additional depreciation, which just impacts the reporting date column, right? So this is what working note number 2 looks like. Then finally, we have working note number 3, where I calculate goodwill. Now, there are two types of goodwill. One is full goodwill, another is partial goodwill. Yes, full goodwill and partial goodwill. How do you calculate the goodwill? Fair value of consideration paid. Now, this fair value of consideration can be cash consideration, deferred consideration. It can be contingent consideration. It can be any such thing, or it can be share for share exchange, right? So fair value of consideration paid by the parent. In this, you add NCI. Now again, this NCI will either be fair value of NCI, or it will be a proportion of working note number 2. That is percentage of NCI into fair value of net assets of subsidiary at date of acquisition. If you go for fair value of NCI, then you're calculating full goodwill. If you calculate NCI as a percentage of working note number 2, then you're calculating partial goodwill. I have already explained this concept in detail in classes to you. This is just again a revision, right? So this is something that we have in goodwill. Then we compare this total with the fair value of net assets of the subsidiary at date of acquisition, which you are again getting from working note number 2. So you will compare the fair value of net assets of the subsidiary in the working note number 2, right? And finally, what we will get is, we will get goodwill at the date of acquisition. Now, this goodwill can be impaired as well. Yes, it can be impaired as well. So this impairment, okay, this impairment, if it is full goodwill, this impairment will be divided between parent and NCI both. If it is partial goodwill, it will just go to parent. And let's not forget the concept of total notional goodwill in case of partial goodwill for SBR students. So partial goodwill, whenever it is there and you're impairing the CGU, make sure you gross up the goodwill and calculate total notional goodwill for the actual impairment amount. Correct? So this is working note number 3. Let's come to working note number 4, that is for non-controlling interest. So you have NCI as per working note number 3. If it was fair value, the fair value will come here. If it was percentage of working note number 2, then that would come here, right? So NCI as it was stated in working note number 3. Then you will add NCI share in post-acquisition. Okay, NCI share in post-acquisition movement of net assets of the subsidiary. From which working note do you get it? The net assets of the subsidiaries post-acquisition movement. From which working note do we get it? Quickly in the chat box. Yes, we get it from working note number 2, the movement, the post-acquisition movement. So NCI as working note number 3 plus percentage of post-acquisition movement minus any NCI share of impairment, goodwill impairment. Yes, that will give you NCI at the reporting date. Okay, if there will be any PURP, if subsidiary was the seller, then NCI share of that PURP will also be deducted. Correct? Then finally, we have fifth working note number 5 for group retained earnings. So we have parents retained earning. In that we add parents share in post-acquisition movement of net assets of the subsidiary, which is again coming from working note number 2. If there was any deferred consideration, its unwinding of interest happens here. If there was any goodwill impairment, so parent share of that goodwill impairment is what is going to come here. If there is any PURP when parent is the seller or whenever the subsidiary is also the seller, so parent share of PURP will also come here. So all that stuff comes here, and finally we get group retained earnings at the reporting date. Correct? Yes, understood? Okay, now finally danger items. Whenever actually we do consolidation, there are certain danger items. So these danger items are which might not have been recorded in the individual accounts of the subsidiary, but are supposed to be recorded in consolidation. Number 1, if there is any internally generated intangible asset, I am supposed to actually consolidate it. Okay. If subsidiary has any internally generated intangible asset, like an internally generated brand, that might not have been recorded in individual accounts because IAS 38 says do not record internally generated brands, but it has to be recorded in consolidated accounts. Secondly, what can I have? Yes, second thing that I can say is contingent liability. So contingent liability as per IAS 37 is actually, it is just disclosed. It's not recorded in the statement of financial position. It is just disclosed. But for the subsidiary at this point in time, you can actually record it upon the date of consolidation. Right? So this is what we have as danger items. I hope we all are clear till here. Shall we move to the journal entries? The pre-populated, are we ready? Okay. Let's go on to our pre-populated. Let me export it over here. Give me a minute. Yeah, there we go. This is the pre-populated spreadsheet, journal entries that I was talking about. And I know a lot of students requested about it. So I just gave myself few days to just make this for you. And of course, it honestly did not take me days, but yeah, I was brainstorming about it. Whenever I got time, I have made this up. And we will discuss it. You can use it to actually solve your pre-populated, because the pre-populated is more about posting. And when I have to post something, it should be in a form of journal entry, right? Then it becomes easier for me. So let us have a look at it. See, whenever there is a deferred consideration, whenever there is a deferred consideration, let me try and uh, upload it here only. Mm, yeah. Okay. So see, this is the deferred consideration journal entry. Let's have a look at it. What is the journal entry for deferred consideration? Goodwill debit, provision credit. So in your working note number 3, whenever there's a deferred consideration, you include it in fair value of consideration. So if in a question, in a case study, they have written, okay, they have written that, yeah. So let's suppose they have written that, is it clear to you? Okay, fine. Let me take you to the same view then. This one is clearer, right? Okay. So let's suppose in the case study, they have written that there was a deferred consideration that has not been recorded. Now, to record that deferred consideration, what journal entry will you pass? You will say my goodwill is increasing because of this deferred consideration, and a related provision is created because yes, I have to make this payment in future. So it's a liability. And let's not forget, we have to calculate it at present value. Now, if you will calculate it at present value, do not forget to unwind the interest. What will be your journal entry for unwinding of interest? If you are making a P&L, it will be debit finance cost. If you are making financial position, you will say debit group retained earnings, okay? And credit provision. So this is how you will post your journal entry for unwinding of interest, right? Then what we have is this particular thing. Many students, they confuse while making the pre-populated that, ma'am, why didn't you debit NCI here? Why will I not debit NCI here? Because this belongs only to parent, as parent is paying this deferred consideration. No, NCI is not paying this deferred consideration. He has already made his payment. So he is separate. This is your liability. So your liability will be recorded just in the parent's books of accounts. So this is what will be your journal entry. I will share this with you. The PDF will be shared with you. Just understand for now. Then increase in net assets of subsidiary at the date of acquisition. Due to any reason, let's suppose there's a fair value adjustment. Let's suppose there was a property of subsidiary which was valued at a lower amount, but on date of acquisition, there was a fair value adjustment. Or there was an internally generated brand or an intangible asset which was not recorded, but you're now going to record it. So what will be your journal entry for that in pre-populated? You will debit that net asset or that asset, okay? So asset debit, so internally generated brand debit, and goodwill credit. Why? Why will the goodwill get credited? What was your formula to calculate goodwill? Fair value of consideration plus NCI minus the fair value of net assets of the subsidiary at acquisition date. If this will increase, the goodwill will decrease. No, that's why goodwill credit. Okay. Decrease in net assets, it will have vice versa impact. So there the goodwill will get debited and the asset will get credited. So this can be fair value downwards. So maybe the subsidiary's net assets have decreased in its fair value, and to account for it, your entry will be goodwill will increase, okay, and the asset will decrease. So in your balance sheet, in your pre-populated, you will decrease that particular asset and you will increase your goodwill by that amount. Now, similarly, on fair value adjustments, you have additional depreciation. So how would you account for it? The additional depreciation. See, this additional depreciation, Why is this happening? The additional depreciation is happening because, ma'am, the asset of the subsidiary, we took it to its fair value, which was a higher amount. So now we are going to have higher depreciation. So the point is, this is the asset of the subsidiary, right? So subsidiary's asset will be depreciated. Will NCI have a share in it? Usually we forget it in the pre-populated. Of course. So if you are supposed to adjust this additional depreciation, your entry will be parent's retained earnings will be debited by the share of parent. NCI will be debited by the share of NCI. And asset will be credited because at the end of the day, it is a depreciation which slashes your asset. Then PORP, provision for unrealized profit if parent is the seller. So what is the journal entry? You all know. If parent is the seller, GRE debit, inventory credit. Because parent has recorded that unrequired profit, right? So what we will have, yes. So what we will have, yes, additional depreciation is time apportioned, of course. GRE debit, inventory credit. Now, if subsidiary is the seller, subsidiary has recorded that extra profit. Now, subsidiary is going to adjust his profit. When subsidiary will adjust its profit, NCI will also have a share in it. Of course, NCI will have a share in it. So what will be the journal entry? GRE debit, NCI debit, and group inventory credit. So my journal entry will be very simple because its subsidiary is the seller, right? So NCI is also impacted. Similarly, if share of profit from associate is to be recorded, let's suppose in the question, due to any reason, they have not recorded share of profit from associate. And in the pre-populated, you are going to record the share of profit from associate. So the entry will be investment in associate, which must be your non-current asset, will be debited. It will increase your investment. And your retained earnings will get credited because it's your profit, right? So it will increase your retained earnings. Right? Then, what else we have? If dividends are received from associate, see, when dividends are received from associate, money comes in. So bank debit. What credit? Investment in associate. Why? Because in investment in associate, as per IS 28, you take your cost of investment. In that cost of investment, you add your share of profit from associate. From that, you deduct any dividends that you've received. Right? So this is something which you will pass as a journal when dividends are received, which were not recorded in the pre-populated, and you are going to record. Okay. Then PORP, if associate is the seller, share of profit in associate debit, group inventory credit. So profit is recorded by associate. So profit of associate is going to get debited by the share of parent in the associate, and inventory is going to get credited. If parent is the seller, then GRE and investment in associate, these are the stuffs that we have already discussed, like, in basic group accounts classes, the intra-group transactions. So these are basic journal entries. Now, very important, this is usually there in the pre-populated spreadsheet. The goodwill impairment. Have a look at it. If your goodwill is getting impaired, okay, and it is a full goodwill, let's not forget that NCI will also have a share in that impairment. So in the pre-populated, they might have missed the goodwill impairments allocation. So what you will do, NCI will be debited, group retained earnings will be debited because parent will also have a share in that impairment, and goodwill will be credited. This is what you will do in full goodwill. But in partial goodwill, will NCI have a share in it? No. So only GRE, debit, goodwill credit, and don't forget in your working notes to calculate total notional goodwill, right? So that is for your basic group accounts, the journal entries that I've brought for you to remember. Now let's move on to change in group structure, which is an advanced topic. So in change in group structure, what we have is, we basically have step acquisition and step disposal. So when there is step acquisition and I'm moving from control to control, yes, you remember that staircase? When we are moving from the golden door of control, which is at 50% voting right. So from 0 to 20, it is financial investment, financial asset. From 20 to 50, it is an associate as per IS 28. Then after this, it is a subsidiary and a parent relationship. Correct? So if I am moving from control to control, let's suppose I had 60% of voting right, but now I have 80%. So what will be my journal entry? My NCI will reduce, so NCI debit. I will calculate it in the working note, the reduction in NCI based on unitary method. My bank will be credited because when I acquire more shares, money goes out. So your headache of NCI is reducing and money is going out. So have you made a gain or a loss? That is the balancing figure which goes via other components of equity. Then step disposal, control to control. Money comes in, bank debit, NCI increases again in working note number. Not a number, but working note, you will calculate based on unitary method, what was the increase in NCI. And then OCE as a balancing figure. Then no control to control, step acquisition. So let's suppose you were having, I have assumed a situation when you were having an associate, okay? So you were an associate. So from being an associate, you have moved up until being a parent. So how will you account for it? First of all, the previous associate will be taken to fair value. So in the pre-populated, it's a very famous question that you have to take your associate to fair value. So your entry will be investment in associate debit because I'm taking it to fair value. So associate is increasing. And GRE credit, if I'm making a balance sheet, GRE credit because it's a fair value gain which goes via P&L, right? Now, I will calculate the goodwill because I finally, got into the parent status. So I will calculate the goodwill. So I will say goodwill debit. Okay, so goodwill will be debited and investment in associate will be credited. Why? By calculating goodwill, I will de-recognize the associate. So what will be my goodwill working note look like? It will be like working note number 3. You will say fair value of consideration paid plus NCI. Okay. Just a minute. Just give me a minute. Yeah. Yeah. So I was here. Let us discuss this. Okay. So first you will take that particular associate to its fair value. Then you will finally calculate the goodwill. So your way of calculating the goodwill will be fair value of consideration plus NCI plus the fair value of previously held associate minus working note number 2. That will give you your goodwill. That's why by debiting, this associate is getting added to the goodwill. So goodwill will get debited and investment in associate will be removed. Then if I am moving from control to no control for step disposal, so I'm going to calculate my profit or loss on disposal. So what will be the journal entry? Of course, the money is going to come in. Yes, the money is going to come in. So if money comes in, bank debit. Now you're getting rid of your NCI at the disposal date, correct? So money comes in, bank debit. NCI is going out. You're happy about it. So NCI debit. Goodwill is also going out at the disposal date. So goodwill credit. Net assets of the subsidiary will be de-recognized. So they are credited. This gives you a profit or loss on disposal, which goes to working note number 5 or the group retained earnings. So this is how you will pass the journal entry for your step disposal when you move from control to no control. Okay, let's move on. Next, we have lastly group foreign exchange for your pre-populated. See, usually what is the rule? I hope this is helpful by far to all. Let me know. Yeah, let me know about this in the chat box or after the class if it helped. So now let's discuss about Forex. So the rules of Forex clearly state, okay, they clearly state that first of all, you should know what is a functional currency. So functional currency is the currency of the primary economic environment for which we have primary factors and secondary factors. So primary factors are the currency in which the selling price is quoted, the direct costs are quoted, and the secondary factor is the currency in which loan is taken. Primary factors also include what is the currency of your competitors, right? So you include all that stuff in your primary and secondary factor and finally decide what is the functional currency of the subsidiary. Now, if subsidiary is autonomous, then only we will use these primary and secondary factors. Otherwise, parent's functional currency will be same as subsidiary's functional currency. Now, guys, when we are doing retranslation in group accounts, you all know that all the assets and liabilities are retranslated at closing rate, okay? And all the incomes and expenses, they are retranslated at average. That is the reason this gives rise to a retranslation reserve. So whenever I am retranslating the net assets of the subsidiary, there will be a retranslation reserve. Now, guys, in this retranslation reserve, NCI will also have a share, right? So what we do is, let's suppose it was a positive, it was a gain, retranslation gain. So you will say my assets will increase, so net assets debit, right? And retranslation reserve, that is parent share, will be credited as retranslation reserve. And the rest of the gain will go to NCI. So NCI credit. But if the same thing happens for goodwill, if the same thing is happening for goodwill, what will you do? See, for goodwill, if it is partial goodwill, see if it is partial goodwill, you will say goodwill debit. Why? Because goodwill will increase in case of a gain. So goodwill debit and retranslation reserve credit because you're just recording the parent's share. So you're just recording the parent share of gain. But if it is a full goodwill, then you will have goodwill debit, retranslation reserve by the amount of parent share, and NCI credit by the amount of NCI's share. Right? So this is what we have. Are we clear on this? I know this is like quite a little difficult, but I hope still it has given you some clarity on what do you mean by pre-populated, right? So in pre-populated in SFP, you have to pass journal entries. I will attach this particular document in the description box. So I have given some time to it. I hope it helped you. Do let me know about the feedback on this pre-populated sheet. And this will help you because I'm sure while doing the pre-populated questions, most things that you struggle with is the journal entries, right? So now lastly, to end the session, let's just go through, certain small standards. So the first small standard is IFRS 13. So IFRS 13 talks about fair value measurement from level 1, level 2, and level 3 input. Level 1 talks about identical assets and quoted prices in the active market. Okay, so observable input, quoted prices and observable input. Level 2 talks about similar assets. Yes, in active market or identical asset in less active market. And level 3 talks about unobservable input. Correct? Now, guys, finally, how do you value the fair value of non-financial assets? You take the highest and best use. And what is the highest and best use? You do it from market perspective, not your individual perspective, right? You take the market perspective. Then the highest and best use should be legally permissible, physically possible, and financially feasible, right? That's for sure. And you should know what is principal market, what is most advantageous market, right? So principal market is which has greatest level of activities for that particular asset or liability. If that is not available, then we take the fair value from most advantageous market. When we are finding out which one is most advantageous market, we take the transaction cost and transport cost both while ascertaining which is the most advantageous market. But when we are actually calculating the fair value, okay, when we are actually calculating the fair value, we do not take into account the transaction cost because it is not the feature of the asset, rather it's the feature of the market. That's it. So this is what you practically have in IFRS 13. So this marks the end of your grand revision. I know there is statement of cash flow as well, group statement of cash flow. But again, that is something which is, okay, that is something that you can do yourself. But I'll just give a quick revision. Okay, so let me give you a quick revision on statement of cash flow as well. So group statement of cash flow. We use indirect method of cash flow preparation. We start with operating activities, then we have investing, and then finally we have financing activities. Now, we all know indirect way of cash flow preparation, but what we don't know is how to treat it in case of groups. So in case of groups, what we do is, let's suppose there was a subsidiary, okay, which was purchased during the year. So I'm just giving you an example of purchase subsidiary. So make sure that whatever amount you pay, the consideration that you pay, you take it at the net amount. You take it at the net amount. So the net consideration means how much money did you pay the bank that was credited versus how much money the subsidiary is bringing along. So subsidiary is bank. So because when you buy a subsidiary, I'm sure you're paying cash, but you're also getting some cash. So what was the paid amount versus what is the getting amount? You have to take it at net amount in the investment activity. Similarly, when you sell a subsidiary, you have to do the same thing. Then, of course, when you have working capital changes, usually when the current assets increase from previous year to current year, we say we've purchased the current asset. So that's an outflow. Yes, and when the current liabilities or current, okay, when the current liabilities increase, we say we have taken loan, so that's an inflow. Now, when I will compare the previous year with the current year, in that, if let's suppose a subsidiary was purchased during the year, so let's suppose the current asset was 200 in the previous year and current year it is 250. I cannot say that this whole 50 is my, it is not my outflow, that I've not purchased the current asset. Maybe the subsidiary had a current asset of 30. So 50 was your movement and 30 was brought in by the subsidiary. Okay, 30 was brought in by the subsidiary. So your actual movement was 20. Now that is your cash outflow. So how do you calculate this? You should know. You have to make it comparable. So in case of acquisition of subsidiary, the opening balance, okay, the opening balance of the current assets and current liabilities, they do not have subsidiaries results, but the closing balance, they do have it. So what I do is I will adjust my opening balance by the amount of subsidiaries results and compare the adjusted opening balance with the closing balance and get the exact movement. So this is something that you should know and you should be able to deal with it in pre-populated as well. Now, again, statement of cash flow can be tested, but SFP is equally important. So I have given you the revision for both of them as much as I could. And for journal entries, there's no journal entry. I hope you know for cash flow, there's no journal entry. We are not posting any double impacts in cash flows. So yeah, so that's it. And I hope I was able to help you as much possible through this one session, and you do not regret joining the session and you have learned something. And by the end, okay, I would say that in the remaining days, I know the remaining days are very less, you should make sure that at least you've given one mock. Yes. And you have done the pre-mock of ACCA. If you want to wait for my debrief, you can. Otherwise, you can watch ACCA's debrief as well. Okay. And the third thing is that please revise your concepts. Now is not the time for practice. Like maybe 2 days more you can do practice, but after that, stop doing the practice and just revise your concepts. So by revision of concepts, I mean you can take up the notes and revise the concepts from wherever you've studied, the source. Just take that source up and revise your concepts. So all the standards are important, whether it's NCA, whether it is your IFRS 15, 16, 9, or whether it is your IS 19, IFRS 2, or whether it is group accounts, or whether it is interim reporting, segment reporting, or it is related to IS 37, IS 10, IS 8. All these are important. Some length is less, so those are called as small standards, but that does not mean that small standards are not important. And of course, current issues. So I have a video on my YouTube related to current issues for self-study students as well. I uploaded it in September 23, I guess, or maybe before that. But since then, it has not changed. It is still same, but only one addition has happened. That is IFRS S1 and S2. And that I have recently uploaded. You can go and check out, or you can just YouTube IFRS S1 and S2, and you'll be able to figure out my lecture on this. So that's it. This marks the end of our session, and I hope I was helpful to all of you. If you would have any further doubts, guys, you can anytime reach out to my team at this number. I am dropping it here. And of course, if you're planning on to enroll in AAA or SBR or FR at any given point in time, you can enroll at www.tgprofs.com, and you can just DM on this number and you automatically get the free WhatsApp group links where we guys can connect and I can share notes, PDFs, and links to the videos that I upload. So that's it. I officially mark this as the last session for my students who are already enrolled, and this is the end of our classes, guys. And all the very best. I hope you all pass with flying colors. Be really confident in the paper, okay? Sometimes things come up that you feel that you've never done. Whether you've done or not, that is a secondary question. But at that point, you feel like this is out of syllabus. So how will you deal with it? You will deal with it with your common sense. So you have to protect that common sense before your paper. So you should be confident. You should trust your preparation, no self-doubts, and please stay away from people who are creating last type panic. Okay, what is this? What is that? They are having their own doubts because maybe they have just recently started the preparation. So that might confuse you as well. So just stick to your strategy, your plan, and just go ahead with full confidence. And I'm sure you'll pass this paper with flying colors. So I hope to see you in AAA now and not in SBR anymore. So thank you. And I hope it was again a helpful session. After the session, I would really appreciate the feedbacks from you about the session, either in the comment section or on the WhatsApp groups that you're part of. So thank you guys, and adieu to all the TGNs, whether it's the premium batch, post-result batch, or crash batch. We finally end our batches, and you guys were great. All the live sessions that we've had, I won't get the opportunity to talk to you again, like in the live class. So it was a great time. This time we had so many live sessions, so I have kind of getting connected to you. So there were so many students I remember by name, and we've had calls and all that will be remembered. Still some calls are pending, which are scheduled from tomorrow onwards. So yes, all the very best to all of you, self-study or not, or TGN or not. All the best, and may you pass and come back with positive results. That's it. Goodbye.